accurate. And if we're to look at what has happened during the COVID period, financial institutions found themselves in a situation where they had a surge in use of digital tools, but their systems were not prepared to handle the traffic they experienced. So rearranging the way or reinvesting in tools and technologies to accommodate a large pool of users is something that financial institutions should definitely look at. And that goes with investing in the change of processes that will be able to support the digital first customer. So, but what I wanted to really speak to is what is the foundational infrastructure in order for you to work in a digital first world. Because if you look at what one has to do to offer services digitally, which means really serving services customers remotely, the first thing is to invest in identification infrastructure, because now you're not going to have customers sitting or coming and sitting in front of you and look at their face and ask for their ID. Now they're going to be more and more remote. So investment in identification, in digital identification services is one of the things that is critical for financial institutions to be able to provide services going forward. Luckily, and maybe also coincidentally, just before March 2020, the Uganda Bankers Association, the Central Bank, and FSTU actually kickstarted a project which was supposed to enable financial institutions, specifically the Uganda Bankers Association members, to get access to digital identification services, which would enable every financial institution to be able to verify the identity of a customer by sending information that is on an ID to the NIRA database to verify the authenticity of a customer. This project was rolled out earlier this year, and I would say half of the financial institutions actually already have this infrastructure, so they will be able to verify customers. I know that more UBA members are coming on board to roll out the same infrastructure, and this should go a long way in helping these financial institutions to verify their customers remotely. I think I should finish by saying that we should look beyond the UBA members, because UBA members work with VSLAs, they work with SACCOs, they work with fintechs. So investment has to be made to extend the same services to these other partners of the UBA members, so that there is a ubiquitous way of verifying identity remotely.
Thank you very much, Timothy. And that is quite interesting, seeing how the partnership plays out in terms of how to deepen financial inclusion. And would like to delve a bit into that, understanding partnerships in the financial sector to be able to deliver a service. And as highlighted by one of the speakers earlier, one of the things that is very important on the quality is one of the determinants is the cost. And I think collaboration is one of the ways that reduces that cost. So I would like to invite Mr. Joseph Lutwama from the Director of Programs at Financial Sector Deepening Uganda, to take us through to understand which kind of partners in and out of financial sector are critical to deliver a value proposition to the users as we bid to extend and deepen financial services. So Joseph, you're welcome. Also take us through what kind of recommendations can we have to be able to have partnerships that that lead us into deepening of financial inclusion. Welcome, Joseph.
Yeah, it's a pleasure to be speaking to everyone. Julie, that's a very interesting question. Before I talk about partnerships that can be able to deepen financial inclusion in Uganda, I just want to remind us that there's usually a misconception that giving someone access to a bank account would sort of be just sufficient to enable them achieve their economic dreams or be able to realize better social and economic livelihoods. What people forget that financial services exist to serve those who already have money. That's why they are called financial services. And I think part of the reason why we are struggling to have many Ugandans be able to use these financial services, despite the fact that there's been increased access, is because people don't have money. And if you're to go by the findings from the FinScope survey, a nationwide demand side survey of financial services, you realize that one of the biggest drivers of limited use or lack of use of financial services is lack of money. So I believe the key foundational aspect that needs to be done if financial services are going to play their critical fundamental role in driving growth in our economy is that, first of all, the government needs to create sufficient conditions that allow for greater economic activity. And until people are able to have income in their pockets and money in their pockets, sustainable economic activity that generates constant cash flows, it will become very difficult for them to see value in having a bank account. It will become very difficult for them to see value in taking out a loan, because if I'm not sure what income I'm going to earn tomorrow, then I'll be very scary or worried of taking out a bank loan. Even the bank itself will be worried of giving me credit because they are not sure about my cash flows. And you find that a majority of Ugandans fall in that category. They have intermittent cash flows. They live hand to mouth. And that's why in the analysis that we did at FSD Uganda, to try and see the economic resilience of households in the event of a lockdown, the statistics were quite, I wouldn't say grim, but they're quite interesting, because we saw that, or the analysis showed us that 1 out of every 2 adults would not be able to sustain their standard of living. That living that they had before the lockdown. For instance, if I was having 3 meals a day, or if I was having 1 meal a day or 2 meals a day before the lockdown, I will not be able to sustain that lifestyle for even 1 extra day without me having to go to work. And that number would increase to 80%, or 8 out of every 10 Ugandans, if the lockdown was to be extended for 15 days. So you can imagine 42 days, what is really happening in the different communities in Uganda. Now, a person like that who doesn't have a sustainable economic activity that can generate sufficient cash flows, becomes very difficult for them to see a value in demanding a financial service. So I think the first fundamental thing that we need to think about is, how do we create more economic opportunities for Ugandans so that they can begin to earn cash flows. Then they will see a value of having a bank account. And once they begin to buy assets, then they will see value in taking out an insurance policy. And as these assets grow and they begin to generate more income and disposable income, then they will see value in taking out investment products, because then they will have excess cash flow that they may want to multiply and grow. So that aside, for those who are already accessing these services and for those who are already using these services, it's also critical for us to have shared financial markets infrastructure. We are a fairly small country. It does not make economic sense to have a lot of infrastructure provided by different service providers. That's part of the reason why you'll have financial services being very costly, because every bank has their own ATMs. Banks would want to have their own points of sale. They would want to have their own agents. They would want to have their own branches. So all those things add to the cost of financial services. So it's very important that we move away from having differentiated infrastructure or operating in silos, and we begin to see how we can have common infrastructure that we can, as an industry, use together, so that then what then remains is for us to compete on the value of our services and products. That will take away a huge cost that goes into infrastructure development and maintenance. So things like identity, infrastructure around identity. If I'm a bank, I don't need to have my own infrastructure that I use for KYC. That's clearly not a point of competition. But yet, if we shared it with other providers in the industry, it could go a long way in improving the efficiency of our services, but also it will go a long way in reducing the cost and increase accessibility and even user friendliness of our services. Infrastructure around big data, being able to share data and information on different clients. It makes no sense for a bank to hold dearly onto their data of their clients. If there are 500,000, you only have access to 500,000 clients. But if, as an industry, we came together, created a shared infrastructure where we can access data and information on all the different people who are accessing financial services in industry, in the twinkling of an eye, in that moment, you then have access to close to 1 million or even much more than 1 million data points, because now you have access to data for the entire industry. Whereas currently you only have access to data to your own clients. Even if you're the biggest player in the market, it's very rare that you'll have more data than you would access if you had access to data for the entire industry. So the other key area where I think we need to have partnerships is in the area of payments. Payments is a basic service that we shouldn't be competing with, because then payments makes it easy for us to move money from one point to point B, from point A to point B, which benefits all of us. And that's why if we all had a shared infrastructure for payments, interoperable payments, that makes it easy for clients to move money from whichever bank to another bank without incurring any costs, then instantly the entire industry, the client or the customer, makes it better for the customers to easily access financial services, to be able to move from one provider to another provider, which increases competition, but also deepens the market. So that's why it's very critical for us to have shared infrastructure in those three big areas that I talked about: identity, big data, and payments. The other key area that we need to work upon is internet, reliable internet. In the day of digital, in this era of digital, unreliable internet really makes it very difficult for us to make transactions. And that's why it's very, very important for that also to be a critical factor. The other is power. We need to have sufficient power, electricity. More so in this era where we're thinking about using things like blockchain, which require a lot of power, and yet they bring a lot of gains to the industry. As I conclude, the other critical thing is around the legal system. Everything falls and rises with trust. And there's no better place for us to build trust in the financial system than having a solid legal system. And more particularly, a system which has a culture of enforcement of contracts. Financial services or even economic activity is driven by contracts, whether written or unwritten. And what builds trust is the ability for us to be able to meet our end of the bargain of the contract. In a culture or in a country where it's very difficult for you to get justice, where justice is always delayed, it will be very difficult for people to trust and enter into contracts. More so in a digital era where the person you're entering a contract into with, you do not see. In a digital bank where the transaction is completed in just under a minute, and you don't know whom you're transacting with from the other end, in the event that you have an issue, how are you compensated? You know? So in an environment where it's not clear on how you can be compensated or how your needs can be met, then it will be very difficult for us to have people trust and engage in the financial services. And then lastly, we will need to rethink the financial sector regulatory architecture or the system. Currently, we have diverse regulators: Bank of Uganda, Insurance Regulatory Authority, Capital Markets Authority, UMRA. Now we even have the National Payment Systems Department regulating the payment sector. There are quite a number of regulators. We even have the ones for the retirement benefits. But where we are going, or where we are, the distinction between different financial services are increasingly becoming blurred. The financial system is becoming gray. It's very difficult for you to know where banking stops, where payments begins, and where investment starts or retirement benefits starts or stops. In such an era, it then becomes very important that we also need to break the barriers between regulators and adopt architectures or systems that are more inclusive and that are more embracing, so that then becomes easier for someone to innovate and for even the regulators to ably protect the investors or the customers. I know increasingly a number of jurisdictions are moving away from the differentiated regulatory structure we currently have in Uganda to those regulatory structures like the Twin Peak model, where you have one regulator that covers prudential, that means capital requirements, and then another regulator that covers market conduct. So in that way, you know that if I'm going to be dealing with people's money, or I'm putting people's money at risk, then I fall under one regulator. If I'm going to be interacting with customers and investors on a regular basis, then I fall under the second regulator. So in that way, you've minimized regulatory arbitrage, you've minimized regulatory confusion, and it's more clear for anyone who wants to play in the market who is a referee and what are the rules. So those are some of the things that we need to be able to think, especially as we enter into this digital era or the fourth industrial revolution. I submit, Chair.
Thank you very much, Joseph. I really appreciate that discussion on the depth of partnerships, right from the financial service providers, with the fintechs, with the technology, and then into the area of as well as the area of regulatory. That is very important, because then it eases the delivery of the service and the deepening of financial services. I just want to have a reminder to the to those that are listening in and are part of us on this conference. Please continue to put in your questions in the chat room, on all the forums that you're at, as well as and those will be addressed. It would be nice if you're addressing it to a particular speaker, so that they can be able to prepare for that those discussions. Thank you very much, panelists. You've given us a very good understanding of what it takes, where we are at in redefining financial inclusion and deepening access to financial services, especially at this point when we are looking at how to thrive in the era of the fourth industrial revolution. I'd like to come back to you, James, about especially looking at what has been emphasized in terms of partnerships, and yet the ability to manage the different regulatory regimes that have to work with the different partners. I'll just give an example. For example, as a financial institution, as a bank, you're able to give bank assurance services, but that brings in the insurance part. So just enlighten us in further as financial service providers, from a place of having products that are relevant to our users, so that they can bring quality to the users. What are the key aspects we need to look at for purposes of product alignment and relevance to the users? Welcome, James.
Thank you. Thank you, Julie. Great question. I see two parts in your question, and that's one that touches on partnerships, but also the other is on the products and the services that we put out there. I really liked what Joseph talked about, and if I start with products and services, the fact that, yes, access is one thing, but if people don't have money, then what product do you actually have? Do they really need an account when they don't have money? And I think even within partnerships and collaborations that we have, whether it's in bank assurance or any other service, or it's a payment platform with a fintech for access of, say, low income or micro loans, there is a very strong need for financial institutions to invest and indeed focus on understanding their customers' needs and services. So as we deliver these products and services, we need to first of all deeply understand what is it exactly that this consumer needs. What does the consumer need to be able to drive usage of these services? We've seen with our experience in banking, we do open accounts, but many of them, quite a huge chunk, almost half of them, remain dormant. They go into dormancy stage because you have actually sold a service that a customer does not like. They're not going to consume it. So as we go through these partnerships, it's great that we invest in learning and research. Now, one thing I like on the policy side is that the national payment system allows for sandbox testing, which allows us to innovate and test solutions, digital solutions, with the public at a relatively smaller scale, and go through iterative processes that help us refine and improve these services for the better good of the society. And I think that vehicle of sandboxing is a great way to ensure that eventually you roll out services that are much needed. Now, as financial institutions and players within this partnership model, critical, I think, for all of us on the issue of of usage and quality, particularly quality. We have to move away from the approach of continuously trying to invest in our own solutions and systems. And that's where indeed the strength of partnerships comes to play in, because once we all converge on a unique and the same infrastructure, we can leverage on that for the greater good of the society. So there are quite a number of initiatives. The CEO of Laborem has talked about what we're doing on the national ID space. The issue of data quality and information sharing for the greater industry is another one that I critically like to touch upon. And it goes closely in the conversations you'll have with the credit bureaus on the barrier of financial card systems. Many Ugandans, for instance, cannot afford to get a financial card, to even get access to a small facility. And once you merge that within the same identity that we all have, the national ID, you eliminate some of these barriers. But indeed, converging to similar infrastructures and discussing this as an association makes it much easier and better for the industry. And that's why I commend the Uganda Bankers Association taking the lead in a lot of these initiatives we've seen, like the Agency Banking Company and other initiatives that will bring all the players to the same table to deliver an appropriate product to the public. Thank you.
Thank you very much, James, and that is very good to see what the industry is already doing to ensure that there is a deepening of financial services. And thanks, James, for bringing in the element of data, because as we all know, what makes the big difference of the fourth industrial revolution from the third industrial revolution is the issue of data. And at this point, I'd like to invite, call upon Mr. Timothy Musoke to speak to us a bit. I know there's a session on technology later in the day, but as a user listening in right now, as one who is using these financial services or planning for those that will use the financial services, what kind of protection do I have about my data? Because it looks like my data is everywhere as a user, in my ID, in my financial institution. How the movement of this information, and Joseph emphasized that that's an area where we can collaborate at industry level. But what is the protection of data that gives that trust element from the user point of view? Welcome, Mr. Musoke.
Thank you. I think the first thing to mention is that there is a new data protection law, the Data Protection Act of 2019, and it specifically addresses the worries that consumers should have about their data that they provide to different providers, whether that is financial institutions, that their data ends up getting misused or shared without their consent. All that has been actually very meticulously catered for in that act. So I think the second point now is we have a law. The question is, do the players that are affected by this law, and here I'm specifically talking about the guardians of the data, the collectors of this data, have they taken an initiative to fully understand what this law is about, and what does it mean for them in case of a breach or whatever? Do they know the consequences? So that is question one, and I think these players need to invest quite a bit of time in understanding that. I have gone through that law, and it has rather very serious repercussions for people who actually breach that law. The question is whether the enforcers actually make sure that the law is fully implemented to its full extent. So that is one. The second part is the custodians or the people who are making sure that the law is actually getting implemented. Currently, this law was introduced by NITA, Uganda. And I think NITA has a responsibility to make sure that the actors that are affected by this law fully understand what that means. So this could be workshops, seminars, webinars, conferences like this, TV, media, basically leverage all channels of communication to the full extent that you can to make sure that the actors understand the repercussions of collecting data from consumers and misuse it. There are very good examples to learn from. Europe has GDPR, which is our version of data protection, and we have worked extensively with it with our customers in Europe. And they have put several measures in place to make sure that the actors that are affected by the law are able to understand the repercussions. And actually, as we speak, several financial institutions have been fined hundreds of millions of dollars for breach of that law. So it is serious. And I know that the Ugandan Data Protection Act is actually inspired by GDPR. So you now have the custodians of the law, which is NITA Uganda, being able to play their part, and then the actors which collect the data and be able to use it for the benefit of their consumers, needing to be able to understand what their role is in protecting this data. I think now the last part is to make widespread consumer awareness of the rights that these individuals that most of the time unknowingly share their data with institutions, thinking that the data is safe and will not be shared or misused without their consent. So those are the somehow educated users who understand their rights. But I think the largest majority of consumers who willingly provide the data actually do not understand that their data they're sharing, they have rights to making sure that it can only be shared with other potentially bad actors or even good actors without them actually providing consent. And I think that's where the largest gap lies.
Thank you, Mr. Msoke, for emphasizing that. And looking at, I will ask in about 2 minutes, Mr. Setimba Ivan, if you can all speak to us about the issue of what is coming out strongly is that there are certain things that as an industry we don't have to compete. And secondly, it's coming out that for us to get into financial inclusion, there's a lot of awareness that needs to happen to the users. If you can take us through from a point of a recommendation, what we can do as industry, for that matter, the Uganda Bankers Association, in creating awareness, especially for what opportunities are available on usage of financial services, but also control. What can we do to be able to ensure that the users, the financial services users, are aware of the risks and that they are protected, so that we can build the trust in the industry? Welcome, Ivan.
Thank you. Yeah, thank you, Julie. I think the speakers have all clearly elaborated some of the issues that we need to deal with. But I think going beyond that, and as we get more people into the financial system, it becomes very important that they understand the risks. So financial literacy and financial education is very, very, very important. And I think it's very key that financial service providers work with the regulator and other stakeholders to roll out these financial literacy awareness campaigns. Because as we get more people into the system, we need to ensure that the system they are going into, they understand the system they are going into, they understand the risks that come with this system. And as we move into the digital realm that we're talking about data, and I think Timothy and the rest have spoken about data, and data is the new gold. So people don't yet appreciate the power of data, of their data, and as we move into more innovation and more digital platforms, people need to understand what is it that they are giving up, what is it that their data can be used for, and should be able to accept this risk and be able to live with it. Of course, the issue of then that ties into the consumer protection. I think there's need to strengthen the consumer protection framework. Timothy has spoken about the law, which is a great thing, but I think now the regulation, the implementing regulations of this law becomes very, very important. But also from a financial from the financial services provider perspective, I think it's very important that financial service providers do protect and also act in a responsible manner. I think we've seen cases where, if you look at digital credit, for instance, in one of the neighboring countries, where all sorts of very not pleasant things have been happening, and people borrow, and then they are not treated very pleasantly. So I think as we move into the digital realm, we need to ensure that we conduct ourselves very responsibly, and I think that's one of the key pillars of financial inclusion: being responsible financial service providers. I saw someone in the chat talk about, of course, the current situation where because of the lockdown and the pandemic, there's been slow economic activity, and of course many people are struggling to pay back their loans. So how do we, the banking industry has come out very strongly, the central bank has come out very strongly to provide kind of stopgap solutions to ensure that there's some level of responsibility. So I think this is very important going forward, sure that as players in the financial sector, we are responsible when we're dealing with customers. Thank you, Julie.
Thank you very much, Ivan. And Joseph, we're getting into the questioning time, but I would like that you follow up with what you submitted on the need to ensure that subscribers or users or account holders have money in at their disposal to be able to be part of the financial system. So what do you think the financial institution or financial service providers can contribute? What is their role to ensure that there can be more money available? Yeah, when you were speaking to us earlier, you emphasized the role of the government. Is there a place for the private sector financial service providers to support that process? And what is that?
Yeah, I think there is a role for the financial system, and I think it starts with investing and financing innovation. every one of us has been gifted with the ability to innovate. And you don't need capital to innovate. You just need a healthy thinking brain for you to be able to do that. It's in developing countries like ours that we don't have financial institutions that actually focus and specialize in financing innovations, that are willing to take that risk to bet on innovations. Until we have financial institutions or players stepping up to the challenge to finance innovations, we'll continue to be in the cycle in which we are in, where we have very few people included. Because if I'm going to go to a bank, they're going to ask me for a land title. Now, that means that the bank is only financing someone who is wealthy, because by the time you have a land title, that means that you already have some money, you're already earning something. Otherwise, you would not have been able to purchase that land unless you inherited it. And very few of us have that opportunity or privilege of inheriting land. So one of the ways in which the financial sector can play a role is by financing and supporting innovation, by taking bets. Of course, the banking structure, commercial banks are not designed to finance innovations. They're designed to finance businesses that are already growing and they have steady cash flows. And maybe that's why we're having a challenge, because the dominant players on our market are commercial banks. And it will be unfair to judge them in that way, because they're not designed for innovation. In fact, they're designed to be risk averse. So we need another section or within the financial system that specializes in financing innovations, things like angel investments, things like private equity, venture capital, things like that, things like capital markets. We need to be able to develop and deepen those sectors so that then they can generate a sufficient pipeline of customers and clients for the more established risk-averse sectors like commercial banking and insurance.
Much, Joseph, for that emphasis on the role of the private sector, of the financial service providers for enhancing financial inclusion and growth of finances for the population. So we'll get into, we have a bit about maybe 15 to 20 minutes of questions. We have a number of questions coming in. Thank you very much for sharing that. This engagement is quite good. So I have a question that I'll get back to Joseph immediately, which is on the financial inclusion strategy. Being from FSD Uganda and the support that you continue to give the industry. The question is from Nasali Fatia of NBS TV. The National Financial Inclusion Strategy was launched some time back. How far has the financial sector gone to attain the recommendations in the strategy? Joseph.
Of course, like I said, we've made some progress, but I must say the biggest progress has been in increasing access points, and that has likely been to increasing mobile money agents across the country, making it possible for Ugandans to be able to access at least payment services. With the launch of agency banking, we have also seen banking services being extended into rural areas, or I could say peri-urban areas. That has gone a long way in addressing the challenges of those who are already banked. I don't think we have reached a critical mass of the unbanked being able to access banking services through the agency banking. That is still an area of progress that we need to be able to strive to, but at least one thing I'm certain is that agency banking has made it much easier for those who are already a bank to be able to access banking services, meaning that if I had to walk for a kilometer or 2 kilometers to open up a bank account or to access banking services, now I can access the same services. I can withdraw, I can deposit from the nearby shop or from a nearby bank agent. That in itself, I could say, is a great stride achieved because it has increased efficiency of financial services, which is one of the critical building blocks of attracting new customers, because then they know that the banking sector is there to be able to meet our needs and it's not aloof and far off from where we are. But the other areas, we still need a lot of work to do in terms of increased usage of formal financial services, increased usage of insurance. There's still a lot of work that we need to do to be able to bring those services to a majority of Ugandans.
Thank you very much, Joseph, and I must congratulate the Uganda Bankers Association on the strides that have been taken to implement the National Financial Inclusion Strategy. Mr. James Onyuta from Finca, if you could respond to this question. There's a question. Mr. James Onyuta has talked about dormant accounts. Has the sector recorded more of these due to the pandemic?
Thank you very much, Julie. Well, I don't have the recent data of dormancy of accounts, but one thing I must say, which we've seen actually, is on the contrary, as we drive multiple products and touch points for these accounts, the level of dormancy actually is reducing, and that's a good thing. And during the pandemic period, we've seen significantly that a lot of transactions are moving from over the counter in bank branches to actually these digital channels. Because one thing you have is that these digital solutions provide not just access to the account, but it also offers payment solutions for these consumers, hence creating a platform that allows them to use that account for other services. And as such, indeed, we've seen that on a trend-wise basis that the level of dormancy indeed will reduce as access points increase. Thank you.
Thank you very much. And I'll stay with you, James. There's another question from Anna Naziwa saying that how are the players addressing the issue of gender inequality since women are the majority of the unbanked?
That's right. Yeah, that's a very good question. And there are a number of interventions that are happening. But I must say that to address the gender issue, you have to critically address the issue that Joseph talked about of products and services that are going to enhance those who don't have the cash or don't have assets to provide to you for credit. So deliberate attempts to products that are clearly targeted to this segment. We've seen that it's majorly the female gender that doesn't have these assets in most of our communities. The other that was talked about by most of our colleagues here is that we actually see quite very many women participating at the grassroots level of the VSLAs, the circles that we've talked about. And the partnerships with these at these levels so that they can leverage on already the good work the UBA has done and the financial institutions on improving their infrastructure will go a long way to integrating and addressing the challenges of gender. Thank you.
Thank you very much, James, for that response. I'll come to you now, Mr. Msoke. We have Ken Ouko, who has a question saying, who will regulate this eKYC data? Will it be NIRA, UCC, or NITA? And how do we handle the customers who, for some reasons, be it political, about their data being used in other areas? I know you had partly answered that, but if you could specify and be able to confirm this. I'll read it again. Ken Ouko asks, who will regulate this eKYC data? Will it be NIRA, UCC, or NITA? And how do we handle the customers who, for some reasons, be it political, about their data being used in other areas?
Okay. I think to be clear, there are two, or let's say three parties that are involved when an eKYC verification, for example, an ID verification happens. There is the customer who has come in front of a financial institution and wants to maybe open an account. They submit to giving the ID to the financial institution because they want to get a service from that financial institution. Now, the financial institution, for so many reasons, including regulatory, and also just their own confidence that they're dealing with the right person, wants to give you the service, but wants to be sure that you are who you are. So they get that information from you, the consumer, and send it to NIRA digitally. And to be specific, today, NIRA is not sharing the information that they have with the financial institution. They are simply saying the data you have sent me is valid or correct. They don't tell you that this NIN belongs to Timothy. They just say the information you submitted to me based on the record that I have is valid. So already steps have been taken by organizations like NIRA that your data is not shared. So at the end of this transaction, this verification transaction, NIRA, which has the information of the population, has provided a verification service, but it has not shared your information. And secondly, the bank that you have willingly provided your information also is keeping a record of you now, one that they now believe is valid, for purposes of providing you the service that you have requested for. So in that specific instance, you know, there is no violation, I would say. NIRA continues to be the custodian of your identity database. And then the bank or financial institution has a record of you for purposes of giving you the service in future. But I think where things can start getting slightly more complicated is when a financial institution maybe has just your ID card number or your NIN and would like to get more information about you. Now, I know that NITA, NIRA, and a bunch of other government institutions are working towards putting infrastructure, which Joseph alluded to, that allows you, the consumer, to give consent before that information can be retrieved from, say, a government agency that has been requested to share information about you. So what is good about that and consistent with the data privacy law is that now you are aware that some institution is asking information about you, and you have a chance to say yes or no. Now that is in the perfect world. Of course, there are some actors that will want to do that without your consent, but that's why the law exists, and the custodians of this law need to make sure that penalties are in place whenever such actors go beyond what they're mandated to do. The last part of the question, I didn't really understand it, where you said for political reasons, you know, a certain owner of the data may not want the information to be used, but I think I've indirectly answered that. If you don't want your data to be used, then the institution that you're interfacing with either will say, okay, you don't want to give me your information, then I can't provide you the service. If you mean NERA sharing your data with other financial institutions or other players without you wanting it to be used, I think the consent part addresses that part, because you will be asked, do you want to share information with this financial institution? And you will have a chance to say yes or no, according to the setup that has been, that at least is being planned as we speak.
Thank you very much, Timothy, for that response. And also just to emphasize to you, Ken, that we have a whole authority for financial intelligence authority that is mandated to ask for that extra information and would work with the financial institution directly. But also at the point of consuming services from a financial service provider, you are given an opportunity to accept or whether information can be shared, especially for credit purposes, as far as the credit bureau is concerned. So you have an opportunity at that point to engage, and the financial institutions, the commercial banks and FDIs, tier 1, 2, and 3, all those financial institutions are mandated to share with you what it means to submit or accept that sharing of information. Thank you very much. So I'll come to you, Ivan. We have a question from Robert Magala. I hope you've seen it, but I'll read it anyway. It's long. It says, we have seen academicians, development partners injecting money into innovation. FSD, DFID, KFW, MasterCard, GIZ, and many others. And the money is being directed to very profitable financial service providers. With the kind of such profits that banks make today, why can't they be proactive in making investments into such innovations? For instance, agriculture financing. Are there institutional barriers that prevent their boards to sanction such innovations? I know you're not from a financial institution, but I'd like that you share from a development partner perspective. I believe it will be able to answer this question. Thank you very much, Ivan.
Yeah, thank you, Julie, for the question. And I think Robert does raise a very important question. I think, at the end of the day, it is important that all the stakeholders in the financial system come together and work together towards creating an enabling environment for innovation to prosper. Why do banks not invest in innovation? I don't think that they don't invest in innovation. Certainly, they have invested in innovation. I don't think the industry is where it was maybe 5-7 years ago. We've seen quite a number of things happen. Some of them might not be seen at the front end, but a lot of stuff happens in the back end. And of course, this is a collaborative effort. So you have development partners coming in and assisting and supporting institutions. And I think the reason why sometimes this becomes necessary is because at the end of the day, there has to be a business case. So if at the initial stage, the business case is not very clear, then it becomes very difficult for the bank for a financial service provider to invest in this particular uh, uh, product. But if there is someone who can cushion or who can reduce the risk, the potential risk from investing in this particular project, and this is in the case of in the form of development partners and other stakeholders, then it provides an opportunity for the service provider to actually undertake this, and at the end of the day, see it come to come out. And I think that I remember there was a very interesting project that happened some time back, where one of the development partners actually put up some money to support the setup of base stations to allow for digitization in the agricultural value chain somewhere, I think in Uganda. And they had committed to provide a grant to this particular service provider, who had not really seen the case to set up these base stations and allow for digital financial services to happen. But it turned out that actually there was a need and there was a business case, and eventually they didn't actually even use the grant, as it were. But because there's a business case and they're able to see it and they're able to set up. But the knowledge to get into this space required someone who could reduce or de-risk this situation. So I think that's the reason why you need development partners, you need you need to look at it from a social impact perspective, because primarily the financial service providers are looking at generating income and a business case.
Thank you very much, Ivan. And indeed, financial institutions actually invest in innovations, because all these development partners will always require the financial institution to co-invest. And this they do directly by putting capital aside for investment in innovation, but also from a human resource and time to commit to these projects. So they actually are investing both directly and indirectly. So we have run out of time for questions, and I have 1 minute each of the panelists as your closing remarks. I'll start with Joseph, but I would like you, Joseph, first to answer this question as our last question, and then give us closing remarks, especially for any policy recommendations or industry recommendations. Joseph, please respond to Nixon Kamjisha, who has asked, as much as financial institutions have provided the basic financial literacy and education to a considerable number of users, I still see a challenge with uptake of digital solutions. What is the plan towards digital literacy? So many entrepreneurs still do not believe that financial institutions can provide efficient services through mobile and digital platforms. What can we, as a financial institution and other stakeholders, do to increase uptake of digital solutions? Joseph, I believe you've seen that question already in the chat room. Please respond. I'll read it again. But also after that response, give us your closing remarks. So the question from Nixon Kamjisha is, what can financial institutions and other stakeholders do to increase uptake of digital solutions? And also, are there plans for digital literacy? Or is there opportunity for digital literacy? Joseph?
Yeah, that's a very interesting question. Actually, I answered it in the chat, but for the beauty of those who don't have access to the chat, What I said, of course, there are many things that can be done, but I think the critical thing that will drive adoption of digital financial services is trust. Because the fundamental game changer in digital financial services is the absence of physical interaction. Now, we cannot undermine the value of physical interaction in building trust, because in a physical interaction, currently, I can see my banker. I can actually engage them. We can even discuss things that are outside banking. All those things build towards trust, that this is someone I can trust. Even the banker, this is a customer I can trust. In the absence of that physical interaction, it's very important that we maintain that trust. And one of the ways in which you can maintain that trust is having a solid legal system that is able to meet justice in time, and it's not delay justice. That if people have complaints, they have issues, they can be addressed in real time. But in the event that these are not addressed in real time, that I'm having problems in my bank account, and you take another 5 or 6 days for that thing to be resolved, then it will be very difficult. However much you teach people about the importance of digital services, if you don't have that trust layer addressed, it becomes very difficult. So I think that's one of the critical things that the banks and the different stakeholders need to deal with, on how you maintain the same trust that people had when they were able to physically interact when they were able to physically interact with their financial service providers. In terms of my parting shots, I think it's good that we have made strides in deepening financial services for those who are already using the financial services, but for those who are yet excluded, I think it's important that as stakeholders and actually working with government, we create opportunities for economic empowerment. Until we create those opportunities for economic empowerment, financial services and financial inclusion will continue to be a pipe dream for many of those who are in the bottom of the pyramid. And this will take a collective effort, not only of government and other private players, but also the financial system itself still has a role to play in driving innovation and driving that economic activity that ultimately will benefit the financial services, as more people are able to earn, as more people are able to own assets, which they can insure and which can generate incomes that they can invest. So that ripple effect or multiplier effect only happens when we work together collectively to be able to drive financial inclusion as well as deeper financial markets.
Thank you very much, Joseph. Thank you. We are happy to have had you here. James Onyuta, Mr. James Onyuta, your parting remarks?
All right. Thank you very much, Julie. Pleasure being here. Mine is going to indeed touch on a similar topic of the financial inclusion strategy that we indeed launched a couple of years ago. Progress has been made, but I think, as rightly mentioned by Joseph, we still have that fragmentation at the policy level that is actually slowing down the pace. A lot of work has been done on increasing access points, but in terms of service delivery and reaching the people that need to be included, that's still a challenge. Progress has been made with the Tier 4 regulation, bringing on board oversight and regulation of that space that deals very much with the level of those that were excluded formally. The Tier 3 MDIs, you still find that the policy and regulations around that do not allow for certain services that would increase access points. And in this particular case, for instance, agency banking. So I think at a policy level, it is very critical that those matters are indeed addressed to eventually start to see the benefit of the strides that the industry has made towards having products that really will enable the excluded to take up these financial services. Otherwise, thank you very much. It's been a pleasure being here, and thank you for having me on board.
Thank you very much for being a part of us. Mr. Timothy Musoke, your parting points, please. Is Mr. Timothy Musoke still with us?
Okay, I think I was unmuted. I think I would like to close this discussion with a reflection, which I alluded to earlier. The last 2 years have been quite challenging for everyone, but for the financial institutions, this is an opportunity to rethink and reflect on how you will come out of the gates when the pandemic is over. I want to stress that consumers have changed. You're going to engage with more and more digital first consumers, and you need to be using this time to be preparing for the traffic that is going to come via your digital channels. So you need to be prepared for that. And if you are, lacking options on where to put your focus, I would like to again emphasize the topic that I've discussed. Identity is the first thing. Joseph mentioned that, and James also. Trust is built when you can, first of all, establish identity. And there's so many things that you can do there. This topic is sometimes taken, not as seriously as it should, but I think that is an area to focus on. I would like to thank UBA for making sure that we're able to discuss this topic. I'd also like to thank you, Julie, for a fantastic job in moderating the panel.
Welcome, pleasure. Thank you very much, Timothy. Ivan.
Yeah, thank you, Julie. My parting shot would be an emphasis on not to leave anyone behind. As the financial system, as the financial sector, as stakeholders in this financial system, we should strive as much as possible not to leave anyone behind. And I think we've already spoken to this. If we look at the gender gap, we need to close the gender gap. We need to ensure that everyone has access to quality financial services. So we need to improve on that literacy. We need to include on the consumer protection framework. We need to ensure we put in an environment that allows for innovation, because we've seen that innovation has a lot of potential in access to financial services. We need to think about sustainability when we are providing financial services. So from a supply side, we need to ensure that these services are provided in a sustainable way. But we also need to start thinking about issues to do with green finance. Probably we're not yet there, but we see already that there are challenges with climate change. I mean, we see, for instance, the landslides that happen in the eastern region, and now I just saw that there will be winds coming up. So these things are happening, and we need to ensure that we are prepared when they do happen. Just like the pandemic has created. Has had a very devastating impact, but has also created some opportunities, and we need to embrace these opportunities and ensure that no one is left behind. Thank you very much to the Uganda Bankers Association for inviting me to be part of this discussion, and warm regards from Abidjan. Thank you very much.
Thank you. Thank you very much, Ivan, for those closing remarks. I really take this opportunity to say thank you to all the panelists. Thank you, Mr. Onyot James, Ivan, Timothy, and Joseph. We really appreciate the insights and learnings that you have shared with us and all the recommendations. And for sure, I see that the fourth industrial revolution gives the industry an opportunity to thrive, even in these challenging times, preparing us even for more growth going forward. Thank you very much, the audience. Thank you for the engagement, the questions. You've kept us engaged. We appreciate you. Over to you, Michael.
Thank you, Julie. I would call for a virtual upload to you and the entire panel. So thank you very much for, I would say, job well done. Quite extensive conversation. And the beauty with digital is that the conversation continues. It doesn't have to end with the session. So let's continue engaging. Let's continue sharing the ideas, and so as we learn together, I am pretty sure we'll have quite a lot of deliberations and conclusions, recommendations coming from the virtual sessions, the virtual engagement that is currently happening. And so as we take a break, I still want to request that we take that 10-minute break. I know that people have been seated for hardly moving. Much as we can't see you, we promised you a 10-minute break. We're going to take a 10-minute break. And in that 10-minute break, you're going to have an opportunity to, go into the virtual exhibition. Different rooms have been set up. But also, during the session, Joseph did mention something to do with agency banking. And so we're going to run a video for people that are keen to understand this whole agency banking and how it works. And that video will take interest of those that are interested in understanding a little bit more about agency banking. And so to my panel that is coming up, sincere apologies. I know you're waiting online. We start at exactly 11:20, the next session. And apologies for those who are saying we are typical Ugandans. But these conversations cannot be just cut short. So, the media team just have the video running, and those that are going into the different sessions, there are quite a number of people waiting to engage you and answer your questions. So thank you.
The shared agent banking system has enabled commercial banks in Uganda to reach far-flung areas efficiently and at lower costs.
There was a latent need of pent-up demand for financial services in areas where the traditional financial institutions were either having a problem or did not find profitable to serve. As the financial sector regulator, we should focus on providing the broad policy and guidelines governing who can be an agent and what is expected of an agent. And then take those rules and give them to the financial institutions, who then use that as a guide in their recruitment and the placement and management of the agents. Their role in success is, you tell us as the participants in the agent banking ecosystem, what it is you'd like to do, where it is you want agent banking to go. We work with you from a risk-based perspective to ensure that you get there, but in a manner that does not introduce systemic or non-systemic risk within the wider financial system.
By 2017, commercial banks altogether had a total of 860 ATM points, serving a population of over 40 million. While this was insufficient to cater for all the customers, it did not make business sense to invest in this expensive platform. The Serbs responded to this need.
At that point in 2017, there were about 800 plus ATMs and 500 and something bank branches. And in comparison and contrast, there were 70,000 unique mobile money agents in the country. So there were 100 times or 100x more mobile money agents than there was bank penetration in the country. Today, because of FSD Uganda's initial grant support and technical assistance, we see around 7,800 bank agents in just less than 3 years since it first went to market.
We cannot continue to open branches each and every trading center. It is a costly affair. The technology cost, operational cost, everything is there. But under this model of agent banking, the number of agents spread across, when you look at Karamoja, customers can operate from TTV, Fort Portal, you name it, wherever it is. We have agents either as direct agent or other banks agent as partner agent for providing the service under the shared banking platform.
The shared platform has opened up opportunities to harness the economies of scale by fostering cohesion amongst the participating banks in a way that customers from the member banks can get served at any of the agent points. Agent banking has opened up opportunities to serve our customers at a lower cost while increasing our coverage and commitment to financially include the previously excluded. The model supplements our existing branch network as well as our digital banking capabilities.
Post Bank, as a government bank, would like to drive digital agenda because we are going to change lives and livelihoods of people through agriculture. You need to reach out to the rural people and also maybe the semi-urban. And with that, the digital platforms really come in handy because one, they're efficient. Two, the brick and mortar cannot be in each and every region of the country. So the agency banking platform gives us an opportunity to reach to the far deep areas, more so where we have most of our farmers and they are able to access the banking services without necessarily being there physically.
There are two major areas of benefit. From a duplication of cost point of view, a shared platform provides one central platform, so they don't have to invest heavily. But also, it enables their customers access services in areas perhaps where they may not have a presence. The second one is banking penetration by itself. Service centers were urban-based, and that means the rural people were not being reached and as such, not enjoying financial services. Today, we have 15.4 million accounts coming from just under 7 million about six years ago. A lot of work has been done.
Besides creating a level playing field, shared agent banking has helped bring financial products and services to a wider and more diversified population, as well as provide choice. Ultimately, this has helped to deepen financial services and accelerate versatile payment ecosystem. The shared agent banking platform had support from several development partners like GIZ and ABI Trust, who saw this as an innovation for the financially underserved and excluded population.
In keeping with the mandate of ABI Finance in enhancing agribusiness lending and agribusiness development, we found it strategic to align ourselves with the matter of financial inclusion. Because the more we have a financially included society, the more the services that we wish to deploy agribusiness lending will reach the intended beneficiaries. So one key success factor that we're very proud of was a quick adoption. The second key success is enhanced financial inclusion. The third success is improved service delivery, where, as I mentioned, as part of financial inclusion, customers or beneficiaries or borrowers are able to do a little bit more than just deposit making. They're able to take loans. They've been able to access services such as insurance. And for us, agriculture insurance remains important.
Our aim is to improve the agro base of the rural economy in selected districts in northern Uganda. And you can't improve the agro base without the use of financial services. It is extremely important that out there in the rural areas, the communities, the people are able to, one, they can reduce the transaction costs, the time taken from whatever activities they are doing to and fro, and also to reduce the risks involved in carrying cash.
SABs have also proved to be a godsend for the mobile money agents. Most of the agents have rapidly adopted shared agent banking as an additional business, thereby increasing their revenue stream.
I've been in business for close to 3 years now, specifically agency banking. Particularly my business before, prior to agency banking, was mobile money. So it is in the interest of bringing this service closer to the people that I had to look around for agency banking. So because of ABC, agency banking, the platform that has enabled banks to share a single platform, you find like it has helped me get so many clients.
We established agency banking 2 years ago because it had futuristic ideas in a sense that people used to come and use the clinic. Most of them used to say they can't pay because either the banks are closed or they can't access their money. But now the money is next door.
I think what we pick out of this is really the benefits, and I can ably relate to the benefits that have come out of agency banking and the opportunity that it has brought and to very many people. My own mother, who is about maybe 350 kilometers and about 30 kilometers out of the main city, Fort Portal. When agency banking was introduced, I told her, you go to an agent, and she was like, but what will that person do? How can she help me get my account? And it had to take a lot of convincing, and when she actually went there, she now realizes that actually she no longer needs to go 30 kilometers just to access the bank. And so I can attest to the benefits that come with agency banking. Given the fact that in many cases we struggle with a lot of some of these, especially mindset, for those that have access to finances. So we are moving on as we get the next panel ready, and I will, as I do the introductions for the next panel, so that we can get started in the next 1 or 2 minutes. Thank you. Welcome to this final session for day 1. And allow me to do a brief intro to those that I'm going to have a conversation with. Let me first invite the gentleman that made it here, and that is Mr. James Biaruhanga, the General Manager, Raxio Data Center, to come and join me on the stage. This session will also be, we'll have Mr. Paul Neal, the Head of Innovation at Experian Africa, as well as Mr. Soren Heitman. I hope I pronounced your name properly. Heitman, Operations Officer, the International Finance Corporation, and that is with the World Bank. Thank you, Soren, for making time. And then Akim Lawal, the Divisional CEO, Payment Processing Interswitch Group. Now, I won't go through the entire resume or bios for the speakers on the panel. What I'm going to do is request each one of them to do a very quick intro, before we go into the questions. And so let me start off with those that are far off from us. And so, Serene Heitman, the Operations Officer at International Finance Corporation World Bank. Serene, if you can do a very quick intro, under 1 minute. And then we'll go to Akim Lawal, and Paul Neal, and James Biarhanga. And then I'll start with the questions. Serene?
Yes, thank you so kindly. Just to confirm my microphone is working, please.
It is working. It is working.
Wonderful. It's a pleasure to be with you today. I wish I could be there in person. I really do enjoy being in Kampala when I have the chance, and I've had many opportunities to work with many of your clients and also with Uganda Banking Association, specifically in data analytics, where I lead with IFC, our Applied Research and Learning Program, and really looking forward to speaking with you today on all of these data analytics issues. Thank you.
Thank you, Serene. You've set the standard. Akim Lawal.
Thank you, and good morning. Please confirm that you can hear me clearly.
Loud and clear. Thank you.
All right. No, thank you. So my name is Akim Lawal, Divisional CEO at the Interswitch Group. I'm responsible for building our payments infrastructure and growing our business across the continent. Maybe just a quick intro on Interswitch as well. Interswitch was founded in 2002 as a payment system. We have been responsible for building the payments infrastructure in several countries across Africa. We have been responsible for catalyzing the development of the payment system in Nigeria, using technology to drive access to financial services for thousands of businesses and millions of individuals across the continent. We also offered solutions to help digitize industries. This cuts across from financial services to banking, airlines and e-commerce, government, formal and informal retail, oil and gas, education, even banked and unbanked services. Our purpose as a business really is to inspire Africa, to solve Africa's problem using Africa's talent. And to that extent, we're very proud that Interswitch as a business was built from scratch by Africans using African technology. And I'm really very excited to be here.
Thank you very much, Akim. And let's now move to Paul Neal.
Very good morning, Michael. We could just confirm that you can hear me.
Loud and clear. Thank you, Paul.
Okay. Fantastic. Thank you very much. And it's a great privilege to be joining all of you online. And like Serene said, it's a shame that we can't be there physically together in Kampala. But a very warm welcome from myself down here in Cape Town in South Africa, and look forward to a constructive debate coming on. I'm representing Experian today, and as you know, Experian is a leading credit bureau across the world. But more than that, I also want to just talk about how we're engaging innovation, because I am responsible for the innovation platform here on the African continent for Experian, and I think it touches very nicely with what the subject matter is about today. And then coupled to that as well is that I have come from a banking background. I have spent 15 years prior to this in financial services on the continent of Africa, and I've worked with two of the largest banks. So I do have the roots and the knowledge about how the East versus the West versus the South works, and all the dynamics that comes along with banking and financial services. So really looking forward to a constructive conversation. And I've been fascinated by the conference so far, some really good questions and really good insights. Most of the stuff I want to talk about has been said already. No, I'm just joking. But looking forward to it, and thank you once again to Michael and to the conference organizers and to the Uganda Banking Association.
Thank you, Paul. Truly appreciate. And yes, you and Serene and all the people that are joining us virtually, we really wish you were here. Yes, so James, please confirm that I can hear you, and then you can speak.
Can you hear me?
You can do better.
Okay. Hi. Sorry, these masks don't do you any favors when it comes to audio quality, but briefly to introduce myself, my name is James Biarhanga. I'm the General Manager for Rockshare Data Center in Uganda. Roxio is the first privately owned enterprise-grade Tier 3 neutral data center in Uganda. I know that's a lot of jargon, but technically, Roxio is the first data center in Uganda that is looking to provide services under the same roof for multiple sectors, whether it's telecom, service provision, carrier sector, financial services. We are looking to provide these services. And the services we provide is primarily co-location, which is basically you bring your equipment to our data center and we can power it up and cool it for you and provide you a good environment. The financial services sector for us has been what you'd say the sector of most focus. The reason is purely because you can't drive an economy without money, and anyone who participates in the money side of the economy is of interest to us because we need to stabilize the financial services industry. Now, financial services is not just the commercial banks or the central bank, but also includes the fintechs, includes the microfinance, includes any integrators and aggregators that actually provide financial services or enable financial services. But the current situation is that everyone is sitting under their own roof and separated by miles. So we're trying to create an environment which is like the heartbeat of the ecosystem for the financial services industry that also attracts people like Interswitch, who are basically providing switching services, MasterCard, who are providing gateways to the international money markets through their online platforms and the plastic market. We're also providing a home for mobile money platforms to be able to operate. This is particularly exciting for us because we suddenly find that Uganda can accelerate towards where the rest of the world has been going for a while. We want to be able to enable integration of all kinds of currencies and platforms in the same roof, together with internet providers, internet carriers, that will, of course, enable online conversations to happen. So, yeah, glad to be here. Thanks, Mike.
Thank you, James. And I don't know how you got to see the question that I have for you because you've answered the first question. So I'll go to the next question, and I'd like to hear from Soren. Soren, there's been, just again, Soren, let me know if I'm pronouncing your name properly, because I don't want you to...
Yes, no, thank you very much.
Right. Very much, great, great. So Soren, here's a question for you that I really want us to delve in. One is, from the previous conversation, what we've just listened to, the last panel, there's been a lot of conversation around data, and we can't run away from data. And so from where you are and the engagements that you have, the question that I have for you is that what would you tell anybody who is getting into this space about the potential opportunities, the power that data does have from a business, but also from an operations perspective, and what are we learning that we need to pay attention to? I hope that makes sense, Soren.
It absolutely does. Thank you very much for the question. I think that the concise answer is that there's extraordinary potential. And I think that we can all recognize it here today because this is a topic that's coming up. Clearly, this session is dedicated, and we saw many questions before. In our earlier plenary sessions, we were discussing stories around data and power and potential of data. And just to share with you an anecdote, research project that was partially conducted in Uganda and also in Ghana, to show a little bit of the potential and power and opportunity of some of the more sophisticated data analytics. We partnered with one of the leading research universities, Stanford University, to do machine vision. That is leveraging satellite data, looking from high above, down into Uganda and Ghana, respectively, to try and assess poverty and income demographics throughout the country based on the features that we can observe from satellites. It's very exciting. It's very, very innovative. And there's an enormous amount of potential. I think everybody would, I would hope, agree with me that, if we're able to get this information by just looking from above through satellite imagery. What are the opportunities to understand our markets, to understand our customers, to understand need assessment of looking at different areas where we can see wealth and income distributions. This project was partially funded by MasterCard Foundation, I'm pleased to acknowledge. And I bring it up for two reasons. One, because it shows the power and the potential. But also you asked, what do we learn from this? And we learn that these are challenging things. They're very difficult. Our own research project, I'm going to say, was interesting in its conclusions, but no grand slam. Really, it just identified the need for more research and the promise of these opportunities. And so I think as we move forward in our discussion today, I'd like to bring my comments a little bit more down to earth, so to speak, and look more at the opportunities I think are practical for our audience today, certainly as we're looking at the financial sector, and where we can look at incremental use of data and innovation and looking at maybe mixtures of data analytics techniques that are, a mixture of things that we're familiar with in terms of an industry, but also looking at where we're pushing the envelope. And so it's exciting, again, to talk about artificial intelligence and all of these next generation technologies, but let's not let these types of conversation create anxieties or let us feel that we're not keeping up. I think a lot of these are properly in the domain of research organizations, such as IFC and some of the other leading research universities. An area where I think we are well to focus. And I'll look forward to hearing some of the comments from Paul Null, as I believe he might also speak to this, is we're looking at credit scoring and credit opportunities. And specifically an area where IFC is focusing, at least within our programs and the applied research and learning area, is on businesses, on MSME credit opportunities. This is an area where we see a tremendous opportunity. IFC, for example, forecast on the African continent MSME credit gap of over 330 billion US dollars. From our own research, and partially in collaboration with the Uganda Banking Association, we see a credit gap of MSMEs of approaching 9 billion US dollars in Uganda alone for our small businesses. This is a tremendous opportunity as well. But how do we identify those businesses? How do we understand their credit needs? What kind of credit scoring applications can we deliver and develop? Again, on our side, we are working on some innovative credit scoring algorithms for businesses, but I think that what we see, and we kind of look at a lot of our digital financial services and digital lending, different kind of products out there, a lot of them are really consumer oriented, giving individuals loans. So how can we take what we've learned from these innovative technologies and where we've looked at these types of applications for individuals and apply that learning to businesses? They're very, very different, of course, as we all know, but the potential is there. And I can even say in projects that we've done with East African clients that we found a lot of opportunities. In fact, one specific engagement, we developed a new credit scoring methodology for small businesses, entrepreneurs, the very smallest, and found lead generation of potentially 25,000 opportunities. I think this is how we should take a look at this type of opportunity. First is what's the need? So for example, I've already articulated in Uganda, for example, a tremendous need. Africa continent is a tremendous need. But from our individual operations, we need to understand what is the need, for example, even within our own client base or our own market base where we're conducting operations. What is the need for credit? And then we need to actually go out and generate those leads. So particularly, again, if we already have existing customer base, where can we get opportunities? Again, as we're looking at the very smallest of businesses, entrepreneurs, for example, I think a lot of what we see is a mix of individuals or very small business owners that are using consumer-oriented products, lending specifically, but other financial services that they may have available to them for their businesses. So I think that segmentation of existing customer base is a strong opportunity. Just understanding, are the people that are taking consumer loans, are they actual consumers, or are they businesses that just maybe they don't have the awareness of other products and opportunities? Data is a tremendous ability to help with this type of segmentation. We've done a number of different markets to just say who's out there. And then once we understand those lead generations and use data, for example, in targeted marketing and find those opportunities, then we can also look at some of the more innovative areas for bringing in alternative data or even leveraging the data that's within our current systems to actually look at credit scoring. And again, kind of keeping my eye towards the future and understanding kind of what's the more innovative spaces, credit scoring specific around for MSMEs. Certainly with the nature of this conference today and the theme of bend, do not break, and recognizing the extraordinary times that we're in right now, we can also recognize that the business sector has been extremely hard hit. And we've seen that a lot of businesses are struggling, that a lot of businesses have reached out to support. And again, from our own research, I can really give strong remarks to Uganda and I think to the audience here today of being able to provide that support, because we've seen that over 90% of survey respondents in Uganda of small businesses have been able to reach out to their financial services providers for helps, whether it's restructuring loans, taking on new longer-term loans with longer-term tenor in order to build back from their difficulties for reinvestment in the future, or even just taking small working capital loans. That this is actually very strong for Uganda compared to other countries that we've seen on the African continent. But there's still tremendous opportunity, again, of being able to use the data in order to help businesses overcome these challenges they've all experienced over these difficult times, and to be able to provide financing into the market and to be using data in order, again, to identify the need for the financing gap, to generate leads for new and potential customers and existing customers on the channel that maybe aren't using the products that are best tuned for their needs. And then, of course, using the data for credit scoring or other innovative technologies in order to be able to generate business, but of course to provide solutions, to be able to further financial inclusion and to be able to help the economy grow overall by stimulating the critical small business segment. So I'll keep my remarks there. I'm very happy to follow up or engage in debate, take Q&A as we move forward, but let me pause there.
Thank you, Soren. I think you set the foundation right, and a couple of things that you do mention there that we need to reflect on around artificial intelligence, the potential versus the power, because you can have the potential, but until you unwrap it, it really doesn't give you the value that you need to look at. The business and SME credit and the whole credit scoring, but I think one of the things that I really pick out in terms of your submission is around what is the need and how can we use data to be able to respond more responsively to the need. And I'm reminded of a financial institution that was in our community. The community is largely an agricultural community, and I went to the manager and I asked a question. I said, do you have a specific product for farmers? They said, well, you see, we haven't thought about it. And I'm like, but so what is your real value proposition to this community if all you're giving the mainstream? And I'll come back to you, Soren, in terms of what we're seeing and the opportunities. My question now goes to Paul. Paul, with all this potential and power that we're talking about that comes out of data and what it gives us, and you from an innovation perspective, what kind of strategies would you give to a financial institution? What are the 1, 2, 3 things that you'd say, pay attention to the following things? Because that will probably, Paul, I see you laughing. You're like, I need a whole day to tell you how to advise these guys. So my question to you is, the data-driven strategies. What do we need to be concerned about and act on? Because the key thing is, What are those things that we can act on in the immediate term that will give us something to work with as we go to the future, as we go to James's data center? So, Paul.
Yeah, Michael, just confirming you can hear me again, just to be 100% sure.
I can.
Perfect.
Yeah.
You're quite right. I was laughing there because, I mean, one or two data points around this is probably 1 or 2 years of discussions, I think is probably a more appropriate discussion. But I'm going to try and keep it as simple and as clean as possible. I think the one thing that we as Experian really understand is scale. You know, if you understand Experian, and it used to be CompuScan again in market, and that was purchased by Experian a couple of years ago. But we are across the world in 45 countries, and we have credit data on 1.3 billion consumers and 183 million businesses. And we service 100,000 customers across all the different sectors. And so in case of that, you know, we really have to fundamentally believe in what we do from data, because data is core. And we believe that data brings insights through innovation. And we have data labs in San Diego, Sao Paulo, London, and Singapore, and in Joburg by ourselves. And what we try and do here is really think about how we can make a difference. And I think the data-driven strategies is a very, very important element for everyone to be considering. But I just want to just say that I do like what Soren said just now about bringing it all down to earth. Because sometimes in these places, we allow complexity to derail us from something that is really simple, common sense, and not complex. And as a result of that, we really have to sometimes just re-look at our thought processes to make sure that we get it right. Now, I like to say that we were into data before it was big. And that just touches on the point that sometimes we can get lost in the volume of information and data, but I'll get to that now. Also just talking about the fourth industrial revolution, which is always a very interesting topic to discuss about. Here's just a thought process for all of you to think about as we continue. We all happily talk about the fourth industrial revolution, but when you ask somebody what the first three were, you don't always get the accurate answers. And so here's a little challenge that we can put out 2 questions later. What were the first 3 industrial revolutions? And then take that back to where we are today. We've heard earlier today, we all know about how data is the new oil, and it's really the volume of it. And there's no doubt that data is valuable and crucial. But having accurate data is even more critical. You know, in today's world, it's so easy to confuse people by just throwing stuff out there, which is irrelevant. But at the end of the day, one of the things that we have to get right is accuracy. Just confirming that you can still hear me all right?
Yes, we can.
Okay, perfect. But what we do with that data is to really build knowledge and insights. And that's what the actual core focus is of a data-driven strategy. And so data strategies for us, and we fundamentally believe in it from a personal perspective and from a professional perspective and with our customers, that it needs to be comprehensive. So although I've just said don't be too complex, but comprehensive is important. We really have to fundamentally understand what we're looking at. It needs to be fair. You know, sometimes, you know, we always hear about all these different components about how people use data for unfair practices, but it needs to be fair. Data strategies need to be enabled by technology. And I want to emphasize enabled by technology. A lot of time, and you might be Rich coming from an innovation person, but technology is an enabler of a business model. And that's what we fundamentally believe in. And one of the important things around any data strategy, it needs to be transparent in both collection and usage. But at the same time, it needs to be exceptionally private and secure. I think we all understand that. And I want to touch on 2 things around this consent-driven, around privacy and security. There's 2 elements which we have to look at. There's a functional element of data collection and data-driven strategies. And then the reality is an emotional connection as well. From the functional side, there's the perceived value of data. And we can talk about a consumer, a community, or a company. And what we look at here is how does data relate to money, time, and reputation? And we focus on 2 things there from a thought process, a strategic process. It's the collection of the data. So that's building trust through transparency. We've talked about trust earlier, and we will continue to talk about trust all along the line. But we also have to clearly state to those who are sharing the data with organizations how the data is collected and for what purposes it will be used, and then we need to stick to that. And then there's also access. Enabling access for this data subject or the data owner, because ultimately it's their data, is critical. And having a portal or access strategy, a single version of it is important. But beyond the functional side, there's also the perceived risk of data collection and data strategies, and that's the emotional side. A lot of individuals are fearful about sharing their information, sharing the data. It can be at consumer level and also businesses and communities. And so again, we want to bring that element of building trust, taking away the threat of what can happen to that data and making sure that it's used wisely. And that looks at how do we store data? So how do you get consent at the granular level? Have this one consented platform, in other words, a single version of the truth. And then also having the control of that and finding the balance between control and convenience. And so to summarize, not to summarize, but to highlight how we believe that there are 3 points, Michael, that you're asking for in terms of building a data-driven strategy. We believe it true for the African market, for Uganda, for East Africa, for Africa, and then even across the world is this is something that we as a data team engage with on a regular basis. Firstly is inclusion. Secondly is understanding. And then thirdly is innovation. Because we believe that these are the key factors in creating a fair, safe, and future-proof data-driven strategic shift in financial services across the board. So let me start with inclusion. This is the data that relates to consumers, communities, and companies that is all-inclusive. And we fundamentally believe that the youth, women, small businesses, entrepreneurship, employment opportunities, and the sectors that are being hit hard in particular around the COVID crisis that we had across the world is what we should be focusing on. And here's a very interesting challenge for yourselves as banks and financial organizations, is what you may regard as good for yourself and as a financial organization may not be relevant to other parties. And so we need to embrace the following factors when we're looking at building value for these value propositions, or building data collection for value propositions. And it breaks down into 3 areas. The first is non-traditional data. Soren hinted at in terms of alternative data. And this is exactly non-financial data that users can relate to. So from a consumer perspective, that might be utility data, telco data, the device data, e-commerce data, online behavior and preferences, social media location, identity, entertainment, assets, insurance. And I rattle it off very quickly, and my apologies for that. But the reality is that that is significant data that might not be relevant for a transactional banking account. But when we are talking about data-driven strategies, we have to understand that. We can also be very sector specific. We talked about agriculture all morning, and agriculture and retail are core components of that. So we need to, again, be careful that the list is not too exhaustive. But in the reality is that we have to address these things. We as organizations and as credit bureaus and data companies and banks and financial services companies refer to all this as alternative data. But in reality, it's just data. I used to live in China, and I try and tell the story this way, is when people said, what is the Chinese food like in Beijing? I just said, they just call it food. And this is the same way. We as organizations should be looking at this as a data perspective, not as an alternative data perspective. The second core component around inclusion is the changing needs of consumers and businesses and communities. Let's be honest, the world is changing, it's changed. Consumers and businesses are changing. The choices that they make, the information that they need, the markets that they address. The Ugandan market itself is very, very dynamic. And one needs to fundamentally understand these shifts in thinking and requirements. Some elements are common sense because we live in the world ourselves, but some are complicated. But data-driven strategies will help clarify this for you as an organization to understand what these changing needs are. And the reality is that in today's world, it changes and changes very quickly. Soren has been talking about the alternative credit scores and that are coming on board. And this is something that we as Experian are fundamentally involved in. We get our hands dirty, we roll up our sleeves, and we get cracking on. Because there's the third component of inclusion, and those are the credit inactives, as we call it, or those that are not in the formal credit sector. And the simple reality of the world today is that, well, not simple. The reality of the world today is we need to boost economic growth. There's a survival element, which is important, but there's also growth. And the world we live in makes this difficult. And access to finance is a crucial driver today for, firstly, survival, and secondly, growth. And credit granting is a strong driving force of this. So getting access to the data, which we are talking about here, is critical. It supports growth, it helps businesses, it creates employment, and finance can be used for very specific requirements. But like I mentioned earlier, this doesn't only relate to traditional financial data points. It talks about all elements around individuals and consumers and communities. Because by collecting this data, and we're doing this live today, by collecting this data, we are able to build a different view on consumers, on businesses. And as a result of that, we are looking at factors such as willingness and behaviors, not just historical financial performances. We're also bridging the gap of getting people financially aware. So financial education and literacy is a core strategic component for any data strategy. We fundamentally believe in it ourselves as Experian, and we drive it strongly in the markets that we engage with as well, because we have to reduce that credit gap. And there is the diversity in who gets credit and who doesn't get it. But there's also this big opportunity, which I like to look at it. And listening to Soren in his introduction and his conversation just now, I think that he and I may be best friends soon, because I think our thinking seems to be aligned. So the second part of a data-driven strategy after inclusion is understanding. Assumptions are so very bad. A validation is critical. We really need to think and engage and drive a fundamentally different viewpoint on understanding how people work, how they engage, how they make decisions, and how they drive different elements. So a data-driven strategy is built on the foundations of discovery. And we talked about research. We can send satellites up into space, but we can also have conversations with people. And that's the responsibility that we need to embrace. So helping the consumers and building data-driven strategies, we have to have understanding, we have to have education, and we must be able to share it. The third driver behind any data strategy is innovation, because innovation is not needed only to see change, but to be change. And to be honest, this is actually exciting. This is an opportunity, because we can make significant differences in Kampala, in Uganda, in East Africa, Africa, and the world. When data strategies are really business models, it's not, again, technology, but it's really a business model. What is your value proposition? What is the commercial advantage for your organization, for your clients, and your suppliers? We try and say, if there's no commercial advantage for all parties involved, we won't do it. That's not innovation. Innovation is breaking those barriers, sorry. So technology is the enabler. And Uganda sits in a very, very advantageous space. Mobile access is unparalleled. The collection of personal information and documentation is something that can be built in a very safe, secure, and trusted way. And you can be very creative in the thinking in this sort of space. But again, we focus on one thing. One thing is that innovation may be creative. Innovation may come up with some beautiful, funny, funky ideas. But we have to do this in a very rigorous, disciplined manner. Because if we have all the flavors and all the ingredients, you will not make a nice cake unless you actually bake it in the correct way. And it's the same with innovation. We have to have business models and business strategies through data-driven alliances where we can have a look at that. So I was going to summarize. It's inclusion, it's understanding, and innovation. And then we come to the point of collaboration. None of this will be possible without collaboration. We heard it in the first session earlier this morning, and I want to continue with that. Data-driven strategies requires and needs collaboration. That can be between government, regulators, the private sector, the communities, financial services companies, banks, fintechs, insurance companies. We have to include telcos. We have to look at industry leaders in different sectors. So if it's agriculture or retail or mining, they have to be involved. And like was mentioned earlier, we have to include the investors. Unfortunately, these things are costly and it will take some money to get invested in. And so the investors need to be part and parcel of that. And then a subject matter we can take for years on end is the concept of open innovation. How do we bring this collaboration together where all these organizations, which could be considered as competitors or rivals, actually become collaborators? And so the open innovation concept is something that we fundamentally believe in and we should be looking at. And people will participate that both proactively and willingly. So at the end of the day, there are lots of challenges and risks. And I know I'm speaking too much, and I'll be another 2 minutes, Michael. We need regulatory support for data-driven strategies. There's no doubt about that. It's a contentious issue, but it's something that needs to be addressed and needs to be done in a way which is open and transparent, just like data-driven strategies will look at. The other challenge related to this, it's quite costly. It requires big investment, but you can be doing that wisely. We have to have real trusted customer value propositions to make sure that we can address them. The data-driven strategies have to be protected against cybersecurity and related breaches, which happen on a regular basis these days. Access to data, not for financial services, but for consumers and companies is crucial. Being able to have a digital platform to be able to have consented granular access to it This also helps a lot in terms of rural and urban market penetration, but it requires a massive culture shift and trust. And I think that's an important element. So this market needs bold, brave leaders, and that's all of you in this audience, I know that. You're also willing to roll up your sleeves and get stuck into driving these strategic drivers. Like has been mentioned before, and we fundamentally believe in this, learning is imperative, knowledge adds value, and a fresh view is encouraged. And at the end of the day, these challenges and risks which are mentioned and the exciting elements that we're pursuing can be managed by all those that are attending this conference. And so we should accept it. We should stand up and make it happen. At Experian, we fundamentally believe that we have the responsibility to help those in need and support social and commercial innovation. We, the bankers in Uganda, all of us in the audience, have the opportunity to use data-driven strategies to make healthy change across the board for everyone. And yeah, very happy to take questions and discuss it. And we've got our country MD on the call as well. So Mark Mwanje, we're happy to have this. So Michael, that's all for me for now.
Thank you very much, Paul. That's really deep insights that you're sharing, and you touched on a number of things that I think we need to deeply reflect on. Let me also inform the people that are viewing us online, please do send in your questions and comments. We will pick them up as they come through. I think your questions are more pertinent than probably my own questions. I will want to see, let them start coming in. Let me come here to James. And James, listening to Paul raises a number of things: inclusion, understanding, innovation, collaboration. I could go on, and typically, if I said, if the session ended right there were lots of things to take away. James, how do we do the transition? How do we get to transition from this high-level conversational aspect, talking about 4IR and all kind of stuff, but also to the realization that we're beginning to see things like opportunities like the data centers beginning to come into our markets. The issue of trust, that if I have my data over at Raxio, it is as secure as having it in my own server room with all the air conditioning that you can think about and access controls. How do we transition? And who are the people that we need to be talking to enable this transition? James.
Oh, okay. Thanks, Mike. I think the topic has been really widened up by the last couple of conversations. So in relation to how we transition, and I want to assume that we, in this case, is not a sector only. It's rather a more global question. It's more, you'd say, nation kind of question. Like, how does Uganda transition to the fourth industrial revolution? How does it transition to digital adoption and being able to actually seize the opportunity? Unfortunately, the answer to the question, in my opinion, actually starts with the realization that we've usually ignored. I think is, first of all, to understand that we're all invited to the party, right? Now, if you choose not to show up for the party, chances are you'll miss out on the goodies, right? Now, historically, when you look at the financial services industry, it was driven by either the player who had quite a bit of cash to invest, or it was driven by someone who was maybe innovating faster than the others, but in a more traditional sense. So you'd find that if for example, a bank or a microfinance had a bigger, just cash deposit, they would sort of bully the market. If you had more branches, you do the same. If you introduced ATM, the concept of ATM machines, for example, it wasn't even so long ago. But it was, people would walk by the ATM and continuously reject the idea and just go into the queue because they trusted getting the money from the person behind the counter, right? So this kind of left a lot of people out of the party. And these were the early stages of transition. And that's, the previous speaker mentioned about people talking about the fourth industrial revolution and not realizing the first, second, and third. Now, if you think about just the steps that we've gone through as an industry is changing in people's attitude is critical, but that is just really the consumer. When we think about the other side of it is the provider. The provider is it the bank, is it an insurance company, is it the financial MFI, is it the central bank, is it the regulators like the Ministry of Finance? Now, the sad part here now is that one can't go without the others. This is we've reached a harsh realization that we can't have the commercial banks move on their own, the central bank moving on its own, and everyone pulling in different directions. How do we transition? First and foremost, we need proper policy. Central bank has to obviously play their role in making sure that the regulation is in place and in play and it's enforceable, right? And this is not just about operations, but also things like the disaster recovery, making sure that business continuity is critical to all the players. The second thing is that we need integration. So in the previous panel, there was a big conversation around data protection and privacy. These kind of laws are pointless to come out from an IT perspective, and they're not being enforced in other relatable industries, for example, financial services. So we need the central bank and NITA, UCC to be able to work together, first of all, to make sure that the policies and regulation is actually aligned and driven towards growth. We need to appreciate the fact that business is now 24/7 and it's online and it's on the go. So everyone who's providing any kind of financial services, we need to access our money any time of the day. We need to access credit any time of the day. When I try and talk to my bank on Saturday and they tell me, please send me an email on Monday, what have I lost from Saturday to Monday, right? The rest of the world is not waiting for you to reply my email on Monday. So we need to realize that just like the rest of the world, we're working 24/7. How do we achieve this? The telcos have taken a huge step with mobile money platforms, which have consequently catalyzed the banks to take the same direction, and then eventually triggered the central bank to take a direction around, for example, the mobile payments platform. This has happened backwards, right? It should have started the other way around, you know, with the platform first, and then the banks and the telcos come in, and then maybe they have their own sector and it's regulated. But now it kind of went the other direction. Obviously, disrupt technology kind of makes this happen. What's happening then? The SMEs, or better still the microfinances who support SMEs a lot and support rural banking, are trying to play catch up because every single person now has got a bank account on their mobile phone. So they're starting to struggle to understand, why do I need to be in a circle? Of course, the conversation is around the savings culture around the circles. What happens when these mobile operators innovate and build circles on the mobile phone? The village circle is going to die, right? So the SMEs, or better still the SME banking sector, which is basically the microfinance sector, is forced to catch up. They need to get onto the mobile applications. They need to be able to do collections and disbursements for their circles on the mobile side to do business on the go. Now, so we've looked at how the telcos fit in. We've looked at the commercial banks, the central bank, the regulators, the microfinances, and that's kind of the ecosystem. But the issue we have, again, is they're all operating in silos. Everyone is running their own show. So you think about global payment platforms, for example, MasterCard. If they come into a country and they want to help and catalyze a given sector or bring in their innovation to improve on service delivery in a given sector, where are they going to find these people? Everyone is scattered all over the world. So there's a need for integration, and integration becomes very critical because now every single player can kind of transact from one platform to another platform, one cell to another cell, purchase to different, and the internet becomes the marketplace. So I think it's time to adopt the internet as the marketplace. Now this adoption basically also makes sense when it is in line with the global trends. Do you know your customer? Where is he based? How do you access him? What services does he want? What are his banking trends? What are his revenue trends? So that KYC, that is not necessarily for onboarding, but rather retaining the customer, is the big data analytics that helps and improves customer service provision by every single operator. So you adopt the fourth industrial revolution in terms of big data analytics into a KYC structure that now helps you not just bring on customers, but also keep the customers. Now, when you can use this information to actually make the right business decisions for your business or for your bank, and then now you can go into the artificial intelligence side of things. How do I know that my customer, James Biaruhanga, needs a loan? I need to be able to know all the information about his trends to realize that this gentleman, every end of month, has exhausted his purchase money, he has made out all his supplies, he needs some bridge financing, and send out an email to him and say, by the way, if you're looking for a top-up, we are able to support you. So personally, I feel like the whole system has to work. Okay, it doesn't mean 100%, but at least over 70% has to work. One without the other doesn't work. If the commercial guys are working without the central bank on board, it will break apart. If the regulators are working without the microfinances, it will break apart. Insurance and all these different players around. The telcos. Because you have to remember at the end of the day, what we're talking about now is internet banking and internet-related banking and internet-related finance. Now, without the telcos in the picture, without connectivity, without data storage, all that stuff is a waste of time. First, you must be connected. So that integration is basically what I think will take us to the transition.
James, you raised quite a number of things that we can't run our own races. We need now to be able to, that success will happen when we are all winning. And everybody needs to have their hands on the deck in order to deliver the kind of value that they really need to deliver. A couple of things that you talk about that I've experienced is yeah, I think one of the banks that I do work with is, or bank with, intentionally or unintentionally turns off their platform overnight, and then miraculously comes back at 8. So I used to send an email and say, I cannot transact, I need to make a transaction, and say, oh, apologies for the inconveniences caused. I was really getting pissed. And at about 8:30, they would say, try the system again. And I'm like, I know it's going to work. But I'm just letting you know about my frustration that I couldn't transact at 8.
So to talk to that same thing, every systems administrator in a bank has something they run called end of day. And it's basically running reports of all the transactions of the day. And depending on the endless balance sheets, trial balance, end of day transactions, you run them. Now, depending on how serious you are as an institution, you can either have a primary and secondary site where you can fail over and run your end of day from a secondary location and leave the primary to keep running normal business. Or you shut down, run your end of day, print the reports, and I've done this job before. This is like 4 hours every day of specifically the system administrator and the computer. You run the process, print the reports, backup tapes, or whichever backup you use. Of course, you do on-site backup, off-site backup. For this to happen, nothing can be happening on the platform, right? Because it will be caught in the wrong day. Now, if by midnight I've opened the platform again, and then the online platform has a transaction registered, and depending on the maturity of the system you're using, then it's caught between days. It's in purgatory. So you find that I would rather keep the system off until midnight, because that's the next day calendar day, or run the end of day late in the night, right? Now, you imagine a situation where you're having dinner with your wife on a holiday in Cape Town, and you can't actually swipe the card because the remote bank is off. Yeah? And these are some of the things where you're running different races. So then another bank will advertise saying that my system is more stable than the other system, so come to me, right? But that's not where you should be competing from. I think infrastructure should not be a competition right? It's an enabler for every business to be able to keep up with us changing. If you have some weak players in your financial sector, it drags down the whole thing. The sector is only as strong as the weakest point in that chain, right? It's like a race with buffaloes.
So James, I think that is also another interesting area that we need to pick up on in terms of internal, because many times we want to be front-facing and realize that there's a lot of work that needs to happen internal. So how do we inside out in terms of innovate? And I'll come back to you. Let me pick on Akim, who again is an enabler like Raxio in terms of ensuring that these things are able to happen. And so for me, my question to you is the financial institutions, how do we get them to appreciate and look at these new innovations that they cannot avoid, but depending on structure, depending on leadership, depending on who is in charge, their decision-making process is, yes, everything is going to wait for us and we will catch up. So how do we, like James did mention, how do we have that integration approach and leave no one behind in terms of this drive to innovate and have an ecosystem that works for everyone? Akim.
Yeah, thank you. Just quickly checking that you can hear me.
Yes, I can. Yes, I can.
No, awesome. I think that question probably, I mean, I and probably the Interswitch team are uniquely able to answer it. In many of the markets where we've played, Uganda, Nigeria, Kenya, and a few other markets, there is a transition and a journey that financial institutions have to make in terms of understanding the opportunities and the potential of opening themselves up to the new companies that will be driving the innovation in the future, right? I think one of the basic philosophies that needs to first come out is from a definition of what industrial revolution that I found. That really talks about that the fourth industrial revolution primarily is around breaking down boundaries, right? It's breaking down the boundaries or blurring the boundaries between physical, digital, and biological wars. Is responsible for delivering financial services to customers. And then it's also blurring the boundaries in the area of collaboration and partnerships that are possible to deliver some of those innovations into the market, right? One of the things that financial institutions across the continent in markets where we've played starts to understand is that they cannot build all the products to serve all the customers in all the markets, right? What new, younger technology companies, fintechs like they're called in our markets and across the world, are able to do is that they can build some of those innovative products. They can build those services that can serve markets that financial institutions are unable to do, right? So as a financial institution, if you're looking to succeed, especially on the innovation point, you literally have two options, right? Option one is to try and build that competency internally and develop your own skill sets to innovate in the marketplace. Option two is really to partner with the young technology companies in ICT or in financial services or financial technology who can basically help you achieve that level of innovation and deliver that to your customers, right? So I think that's the first point. The second, and we get this a lot, is that several financial institutions are still afraid of new technology, right? There are questions around what is this going to do to my business? How does this affect my legacy business? Can I really deploy this in my environment? Will I find the skills? Will I find people to be able to do it? Can I invest in the technology? Can I afford it? Right? And what we're finding is that more and more of the financial institutions who are succeeding in the new world, so to speak, are those who are able to embrace new technology, those who are able to look at big data, who are able to understand machine learning, who are creating APIs and making that available to tech innovators and then using that to give them access to their systems, give them access to their customers, give them access to their data. And I think one of the best case studies I can use to illustrate this is one of the partnerships that happened in Nigeria, where a collaborative initiative was used to deliver consumer financial services and nano loans to customers who were largely unserved by the financial industry in the country. If you know the market a little bit well, it's a population of about 20 million people. About 160 million of that is unbanked. And even if you look at the financial loan portfolio, less than 9% of it is going into consumer lending. So what this was really a collaboration between a tech company, a number of financial institutions and telcos to deliver nano loans to consumers who were not served by any of the financial institutions. And these customers could then basically have access to loans from anything from $1 to $1,000 to be able to deliver, to be able to either meet their needs or grow their small businesses, right? And there's something interesting about how this played out. In Africa, one of the big challenges is identity and KYC. When we talk to some of the foreign companies who do data and analytics, they talk about credit score, which is great. But there is a fundamental problem that first needs to be solved. It's who is the customer, right? How do we know that this customer is the customer, right? So being able to pull data from telco, from banks, and from technologies like social media, you were able to collaborate to create the answers to the 4 key questions that I think allowed that kind of initiative to work. The first one really is, who is the customer and how do we validate their identity? In a market where the national identity is not available to every customer, it was really important to be able to use a digital footprint, a digital identity to say this customer is this customer and therefore I can deal with him. Right? The second really was around will they pay? And by pulling data from telco, from banks, from social media, you were able to answer that question by building machine learning algorithms that are tailored to the kind of behaviors that we see in our markets to make that determination will these customers be able to pay. And then the last one is, can they pay? Right. So one is will they pay, and the second is can they pay. And for that, you wanted to see their financial flows. You wanted to have access to how much was coming in, how much was going out, to be able to make a determination of what quantum of loans you want to be able to give to them. And then the last one, which really is not related to lending, but it's more related to what will the customer need, right? By looking through the data that this initiative was able to collect, you could begin to predict what will this customer need. Do they need something for farming? Do they need something for schools? Do they need something for health? And the data that was pulled together was better able to allow this collaboration to build the insights into what will the customer need in the future, right? So in order to be able to do this, I think one of the things that banks kind of need to understand, or financial institutions generally, is that you might need to create frameworks that allow the parties within such an initiative or within the ecosystem of payments to share data. Right? And I would really recommend that the market in Uganda consider some form of open banking framework, right? That allows a structured, clear way for the sharing and collaboration when it comes to accessing customer data and delivering financial services to customers, right? Following off on that, obviously, there's a clear need to also then define the data protection rules that will come with that. I know the European Union has been very successful with GDPR. Nigeria also launched NDPR. But creating a data framework is really important that defines the rules of who can use the data, how can the data be accessed, how will it be stored, how will it be protected. Right? So that's another piece. And then the third piece really is around banking them. Right? I think there is always that fear that if the fintechs or the tech companies are successful, would it create a challenge for the financial institutions, right? And what we're finding is that, again, banks have become extremely successful at banking these tech companies, right? So first of all, meeting their financial needs as a financial institution, but also meeting the financial needs of their customers. And then using the growth that those companies achieve to also grow the financial institutions business, right? And what we're seeing with many financial institutions across Africa is they're positioning themselves as banking as a platform, banking as a service, and using the infrastructure that they've created to support these tech companies. Maybe two other points on this, before I talk about some of the risks that might come out of this approach, is really the need to guide some of these tech companies through the compliance and regulatory frameworks, right? Usually these are younger companies who don't care or don't understand the regulatory implications of some of the things that they're trying to do. And we find that financial institutions are more successful if they're able to support and guide them through the hurdles that they need to go through in achieving the right compliance and the right regulatory frameworks, right? And then finally, is basically just invest, right? I know several markets prevent financial institutions from investing in tech, but if that's not the case in Uganda, then really a situation where the financial institutions are able to invest in these tech companies positions them more closely aligned to the objectives of the financial institutions and helps them to deliver on their objectives, right? None of this obviously is without risk, right? And I think top of the list when you look at the risk related to that will be the cybersecurity risk, right? I think one of the comments made earlier is that in an infrastructure like this or in an ecosystem like this, you're only as strong as your weakest link, right? So opening access to tech companies and innovators does introduce the entire system to a certain amount of risk. And I think the response to that really is to insist on setting minimum standards, right? And there are quite a number of frameworks out there that you can insist on compliance to before you allow parties into the ecosystem. And the use of third-party certifications is really powerful. It's a way of getting tech companies, for example, to comply with PCI DSS and some of these interesting regulations that are coming there. And they use third parties to make sure that those certifications are actually complied with. The second really is around compliance. I know many financial institutions are afraid of getting into trouble with regulators because if they do open their systems into tech companies, they face the risk of compliance. And usually that just starts with KYC. How do you make sure that the tech company you're partnering with, who's bringing customers onto your platform, is meeting the minimum KYC? And again, usually a compliance engagement at that level enables the financial institutions to deal with those problems at the beginning rather at the end. And the last point really is around data protection and risk. And again, a framework is really important for this. A framework that allows the anonymization of data, that customers must request for the data, the protection of that data by anybody who handles it, and the use for only the purpose for which it was intended and approved by the customer is absolutely crucial. Right. So those are some of the initial thoughts, and I'm happy again to answer more questions as we go on.
Thank you very much, Akim. And we have about 20 minutes to bring this to a close. Again, using data, we have been using approximately about 7 minutes in our initial responses. So I'm going to request that for the Q&A, average 5 minutes. For the Q&A, I'm going to request that we keep it short and the conversation will continue. Apologies, and where I think you're making another presentation, I will interrupt, and don't feel bad, but I just want to have as many questions responded to, and thank you for accepting. So I have the first question from Brian Mutunji, and the question is to Paul. And Brian appreciates the insights on data-driven strategy. However, in a market like Uganda, where there isn't that single source of authentic data, where do we actually start? I appreciate there is a lot of data seated in different sectors of the financial space, but how do we bring all this together? So over to you, Paul. Tidbits, and then we go to the next question. I have about 15 questions here, so I'm being mindful of that. Apologies.
Yeah, I think it's a very good question, and a complex answer is required. So at the end of the day, Experian as a credit bureau in Uganda can only collect data from financial organizations according to the regulations, which we know are being worked on at the moment. So that's the first thing. The second thing is what I mentioned very briefly in my conversation around open innovation, where we have to, as brave leaders, start working together to collate this. Uganda has its own challenges. I know the national identity system, which was mentioned earlier, is an issue there as well. But it's something that we'll reach out privately to them at the same time to address this. And I think that's, again, this is the purpose of today, to generate this type of discussion. But there is no simple answer to that, sadly. But it's something that we have to solve for. And it's very clear, even listening to what Akim was saying now as well, that there's an incredible need for it. So we'll get stuck into that. So I don't want to say I'm not answering the question. I'm saying it's a complex answer, and I can't answer it if we have 15 questions in 5 minutes, but very happy to reach out to him through Mark and myself after this session.
Thank you, Paul. I have a question, actually 2 questions I'm going to combine for you, James. One is about the relevance in terms of offering that you're bringing to the market. Yeah, competing against players like Amazon Web Services, Microsoft as well, and Google. And the second question is, how do you help banks? How can you help banks on what they are best doing and make significant revenue margins without huge costs of maintaining their data centers? So take those 2, and then I'll come back. You probably seem to be a good target here.
Hope that's just a threat. Yeah, so first, we don't compete with the Amazons and Google and Microsoft, as you put it, but rather we are an enabler. These big global giants who are playing or driving the internet, but now they've also started driving the cloud, and also, of course, consequently getting into driving a lot of the online financials. They actually are looking for a home to deploy and extend their network closer to the consumer, and that's what precisely Raxio is. It's a home that can not only be a home for the Ugandan enterprise, whether it's financial or SME, through cloud or telcos, but rather also home for the international, because of the standards that they look for, the certifications that they look for, the amount of uptime in terms of SLA and redundancy that they look for. So we've designed a facility and built a facility that meets global standards. So we have also engaged all of them in conversation to see that we can bring them into Uganda so that they are closer to you and be able to provide you with services nearer to the consumer. Of course, that makes them more stable and likely more cheap to adopt and pay for, because you'll basically be accessing them locally, and you don't have to spend as much on your internet as you would to access them internationally. So to that regard, I think the idea there is that we are looking to enable bringing these OTTs into the country. The second question was about how do we enable banks to probably grow their business in these challenging times and the high cost of running in-house data centers, and also maybe in any other way. I'll give you the answer in threefold, again, in the interest of time. The first thing is compliance to regulation. It was also mentioned a little bit earlier. So we want the banks to be able to actually be compliant to regulation in terms of having at least 2 locations or 2 sites that they can store their IT equipment, which holds your customer information and all the bank information. So we basically can provide a location for either primary or disaster recovery location for the bank's equipment. That basically gives them a chance for business continuity. The example I used earlier in terms of any downtime, we are no longer in an era where you can actually switch off the equipment that you use to provide services to the customers. We're in an era where we must run 24/7. So we provide them a location where they can basically bring the equipment for disaster recovery or primary, which not only gives them a chance for business continuity, but also gives them a chance to be compliant to regulation. The second thing, which is probably now the more interesting conversation for people in the bank, either IT or finance, is that our solution basically provides an operational expense-driven approach rather than a capital-driven approach that banks may be currently used. So instead of you spending money building a data center in-house, why not spread that money out and use it for your core business, right? Already there's a cost of running a data center in-house, which we take away because we basically provide resources to support your equipment. We have economies of scale because our facility is designed for 400 racks and 1.5 megawatts of power. So our cost per rack, per kilowatt, so to speak, is a lot lower than you if you're designing a much smaller, data center for like 10 racks in-house. So technically, when you look at the value proposition we bring in terms of cost to run the facility, the power that we provide and how clean and stable it is, the cooling options we give you, the security we provide in terms of perimeter and actual physical security, including things like CCTV and caging and solutions like that. For you to be able to actually provide the same kind of level of service in-house, it's going to cost you a killing of money that you'd rather use to lend or do the actual bank's core business. So basically, we provide what you'd say a total cost of ownership that's lower and the value proposition that allows the bank to actually go ahead and do a lot, more focused business. Technically, to the end user, this also basically means you get a much more stable service. Whenever you need the service, you get to be able to choose from multiple providers of financial services, but even more so, the perfect competition that's created by these kind of ecosystems basically means that you could actually end up with maybe more innovation or even a more affordable service from your provider.
Thank you very much, James. And yeah, as falling short of collecting commercial fees, but we'll allow that you're here since you're one of them. No, but I think what you've done is you've really deconstructed the whole essence of data centers and the value they bring to the ecosystem, especially if we're going to if we're going to get our financial services delivering at any standard that we all want to experience. This question is open, and so I'll probably throw it to Soren. Given the fact that you have this exposure and the opportunities that come with it, it's around green financing. Do you think Uganda is ready to take on this, and what are the one or two things that we can do to get the green financing up and running? Soren.
Yeah, thank you very much for the question. It does fall a bit outside of my own expertise, but certainly IFC as an organization, we do work in green financing, and there are a lot of initiatives to provide green loans. Again, while I cannot speak to these initiatives personally, I would encourage anybody that is interested to reach out to IFC to better understand where we are able to support with financing. So I'm sorry I'm not able to give a more comprehensive answer.
I guess what I'm hearing from Soren is that yes, there is a lot of opportunities, and there's something that could definitely be picked on. But Soren, just to have a follow-on question for you is around. I'd like to pick your insights. We talk about data or digital transformation, and we largely talk about three things. We talk about the people, the processes, and the technology. Now, the conversation that has so far taken place is around processes and technology. I'd like you to shed in 1 minute or so, what do leaders who are listening to us here or watching us, what are some of the things they can do around the people? Because what we know is that you may have the best technology, but if the people don't have the competences and the capacity, they will still operate in the 20th century mode. So what are some of those things that leadership needs to take on to make this whole shift happen?
Yes, absolutely. A very important question. And I think one of the things that's impressed me as both a participant and observer on today's panel is the consistency of the remarks. Clearly different perspectives, but I think all the panelists have very much been in alignment. And one of the points of alignment is that we need to look at an ecosystem from individual clients, customers, regulators, everybody's a player. I would encourage people that are asking these questions to themselves about internal capacity of looking at your own organization equally as an ecosystem. There are a lot of actors. You have your management, you have your sales, marketing, you have your own internal data. Even if you don't have a strong business intelligence or data analytics team, you do have people that are working on data and you are collecting data. And in fact, maybe to even piggyback a little bit off the question posed earlier to Paul about where do you start, while complex though it may be, I would answer it really succinctly as you start internally and you look at yourself, the data that you are collecting, even if it's paper. We do see, even today's time, people collecting data on loan or originating loans on paper. And this can be digitized, it can be a source of information. So look at yourselves. In terms of the capacities around that, you need to embrace and understand the data. So somebody internally should be looking at it. Your management team needs to embrace the innovation and the creativity. This might take a very specific form where we do see today that there are more positions being created, such as chief data officer or digital officer. That can also just be empowering individuals within the team in order to have these roles to explore the opportunities that your own data can provide, to do stock taking of the data that you are collecting, maybe to onboard data operations expertise. So people that can help you understand what data you have and what good is it for your business. Those individuals very much need to have sector expertise to understand what is your business and what is your data. But very often, very small starts in kind of building these capacities, understanding what you're doing yourself internally, and providing an open mind from senior management in order to pursue those innovations can really get very strong gains. So I think this would be my short and quick answer to that question. Thank you.
Thank you very much. Thank you very much, Soren, for your response to that. Again, this is quite open, and I will take the liberty to send it off to, I think, Paul, you can probably go for this, but I see a couple of questions for you, Paul, so I'll probably give you some breathing space. Let me go to Akim. Akim, there's a question around the constructing of data management, and the question is, what kind of data is at bare minimum shareable, or could we be of concern to the data owner in terms of privacy? The question of what is bare minimum shareable, and he gives an example. I'm not sure whether you're aware of this, but yeah, some airline workers shared images of family members of a particular politician. Again, that is very local context. But in essence, what is bare minimum shareable for any person in the organization, especially in the financial sector? Yeah, a quick response to that, Akim?
Yeah, thanks. I do think I can respond. And I think one of the core principles that is common to all the data protection regulation is that before any data is shared, the customer must request it, right? So I think it's as a principle across all the regulation, any piece of data that is personal to an individual customer, the customer must request that that information is shared before it can be shared with a third party, right? And I think therefore the answer really is that there is no minimum. You shouldn't share anybody's personal information without that person's consent. And I think that's what most of the data regulations stipulate.
Thank you, Akim. I have another follow-on question for you. And this is, directly to you as a business. And the question is, it's from Damali Elizabeth. Very interesting initiative on big data used for credit. How did you get all the industry players to avail access to their data with all these data privacy laws? Was it through a central bank as a mandate? In other words, who brought you here?
Okay, so there are, again, we do have experience in several markets, and I will give examples from some of those markets. But for the specific case that I gave, it was an initiative championed by industry players, right? So it was a couple of industry players came together and said, we do believe that this initiative is best delivered to the market by collaboration. We then got around the table and said, how do we build the solution that solves the problem, and what do we each need to contribute to that solution, and then how do we build a commercial model to deliver that innovation into the market in a manner that everyone who is a participant and has provided input into the solution benefits, right? But I think that's possible because of the kind of role that Interswitch plays in the market where we operate as a payment infrastructure. And we already have that reputation as being a neutral infrastructure that others can use. But in other markets, we have seen this kind of initiatives driven by the central bank by creating either a framework or a policy or some kind of shared infrastructure that everyone is then mandated to use. In markets where the central banks have not been involved, we have seen the Bankers Association come together to set up an entity as well and say, this entity we will all trust. We will provide access to that entity to be able to deliver industry initiatives. Right. So those are the other two models that we've seen, but our model was completely private sector driven.
Thank you, Akim. Paul, I have a question for you, and it says big data, and this is from Ken Ouko. It says big data-based credit reference systems gradually attract wide attention due to its advantages in remedying the shortages of traditional credit reference and dealing with the new challenges arising from financial credit management. Has Experian tried to adapt this new trend? It reads like an exam question, but I hope you have a synopsis for this. Paul?
Yeah, Michael, thanks for the question, and Ken as well. It is a very good question. And just to summarize very briefly, we have as Experian explored this substantially across the world. One of the things that is obviously very, very important and critical that we as a credit bureau have to address is all the regulatory requirements with regards to that, in regards to the collection, processing, and management of the data, the application of the technology of using it, using technology over and above the sort of the source data and seeing what we can do. Like I mentioned in the first answer to the question to Brian, is that in Uganda ourselves, we are limited by the regulatory environment in terms of what data a credit bureau can actually collect and collate. And so that's why we're talking about, consolidation of data is a very important element of collaboration with the regulators, government, as well as the private sector and financial institutions. So to go back to what Ken is answering, is we have explored it. Like I said, we've got some incredible thinkers in the group across the world that are experimenting with this type of technology to make sure that the value on the outset of it addresses the accuracy of the information, addresses the transparency of how that data is used, protects the ability to keep the individual or the consumer or the company information confidential, and then build sort of insights around sectors, behaviors, geographies, all those sort of components at the same time. So I think you had a follow-up question to that as well around the blockchain technology as well. So we are quite excited about blockchain just generally as a technology, and most of the world associates blockchain with cryptocurrency, but we see it as a very core component around having a single version of the truth across multiple parties and having the ability to reliably and confidently use the data that is stored in there to make top-end benefits. That makes a little bit of sense. So I do think that there are lots of elements to explore and lots of characteristics of data management to bring into it, but absolutely. You can rest assured that Experiment is investing significantly in seeing what are the best new trends out there and future-proofing itself and driving that sort of component at the same time. Thanks, Michael. I hope that answers Ken's question.
Yes, you have. And so I have 2 questions left. James, there's a question around making digital infrastructure a basic public good. And the other question is around how sure we that Raxio may not lock us in once we join. And have you any other customers ever experienced unpleasant surprises? And then, so the question is, how do we make digital infrastructure enabling environment a public good? So that companies, individuals can also be able to benefit from that. And that is from Robert Tumwine. And then the other question around, won't you lock them in once they come in, is from Ken Ouko. Let me read this other question to Soren. You'll respond right after James. And that is, thank you for a great discussion on data-driven strategies. And this is from Goreti Masade. The need for financial capital investment policies and processes in the journey of leveraging the 4th industrial revolution has been well articulated. This almost alienates the smaller players with less financial muscle, hence the need for collaboration, integration, etc. What is the need for human capital? Who in the organizations need to be on board? And what fraction of staff needs to be on the table? So, Soren, you respond to that after James. James, to you.
Okay. First of all, I'm very happy that someone has provoked a question around the cost of connectivity. This is something that I'm a very big advocate for, especially because I've got a background in connectivity in general. So I want to throw an example of typically our each of our lifestyles with financial services that providers we have. There are lots of times I'm also guilty of going to the ATM when I don't need to, going to the bank branch yet I don't need to, and technically not leveraging the power of online. Now, online is driven by, of course, connectivity. And half the times we're lazy to use online is because of the associated cost with it, and sometimes, of course, sensitization. Now, from a cost perspective, I think that we really should not be paying for internet in general. And that's a bit controversial because I'm an investor in a telecom company. But I think internet should be an infrastructure. Services are what we should pay for, services that run on infrastructure. Then you can choose what you want. But it's inevitable that we're going to get there. The price of the internet is going to crash and crash and crash until it's not there. And the reason is because the internet price comes from about 4 different things. One is access, the cost of access, which is basically the last mile, whether it's Wi-Fi or 4G or 4G, 5G or fiber, whatever. That's one element. The second element is basically what you'd say fees, like taxation and anything else around it. Then the third is return on investment to the shareholders, and then of course the fourth is upstream, the cost of upstream, which is basically transport and submarine cable components and stuff like that. Now, with the arrival of, for example, data center, first and foremost, is that it starts to build local content, right? And local content not just from the makers of the content, but also the switching of the content. Now, the moment we're exchanging all our data, or most of our data locally, and we've managed to attract the content providers that were mentioned in the previous question, that were presumed to be competition, but rather for us they are part of the customers we enable to come in, it means most of the content will be switched locally. It cuts out a huge chunk of the international segment, which is usually the biggest segment, right? So if we drop about 50% or 60% of the price already by cutting the international segment, it means that we stay with the smaller part to look at. At that stage, already the price will be looking slightly more insignificant. Now, I think providers of services will have to start innovating and starting to find ways of absorbing some of these costs within their services, which doesn't necessarily take away the cost, but it could shift, for example, who's taxable for a given service, right? And that basically reduces on the overall cost. I think, without a doubt, the growth of local content will force the price to come down, but most importantly, the growth of peering between local service providers, local telecoms, financial services, government, like NITA and URA, everyone growing the local internet exchange point as the peering point will drive the price of internet down. And what we've done about this is by basically partnering with the internet exchange point to be present in our data center so that every single customer who we have can peer in the internet exchange point and keep all the local data in country. That drives the pricing down. So this is basically something that's already in motion. There was the last question around how are you sure that we won't lock you in? I'm not sure what the context really is, but I think the idea is traditionally the data center business or data center service was being offered by people who had built their own data centers for their own requirements. And then they would sell off, of course, a bit of excess capacity to the market. Now, what has changed globally is the arrival of neutral data centers. And neutral data centers, like ourselves, are built and purpose-built to provide only data center services to anyone and everyone in the market. So we're not basically, it's not a side hustle. It's our main business. And our main business is to be able to provide a service that can actually enable every single customer within our facility to be able to leverage and to grow within there. So the contract structures that we have really are built on that. The service level agreement we have are built on that. We want to enable the markets rather than cripple the markets. And we are open to everyone. So we define ourselves as carrier neutral and cloud neutral, so that we can basically accept anyone to provide the service and everybody that wants to enable the ecosystem to come in the same place. And we basically align with the Data Protection and Privacy Act, mostly because it also hinges on data sovereignty, which is keeping data in the same geographical boundaries or in country. So you can feel safe that if you had to choose a place to be, it has to be a neutral data center because it's aligned with everything that usually scares people about going into data centers.
We can never respond to all the questions that are coming in within the time that we have. I'm still seeing a couple of questions coming in. My request is that we have these conversations continue. And so my apologies to the questions that I haven't read out. It's not that they're not important, they're very important. But some of the people that are going to make their final comments, I'll ask them to make the final comments and their recommendations as they respond to some of these questions. And so I'm going to start with you, James, around what you've been talking about, the whole public infrastructure and that kind of stuff. And as you make your final comment and recommendation, the question is, how do you work with entities like Experian who are providing that backend and capabilities as an enabler is there a space for you to work with them? And then your final comment and recommendation.
Yeah. So in general, I'm a firm believer right now that integration is the way forward, and integration on a very, very macro and micro level. I believe that there's a need for microfinance to be able to integrate with the commercial banking, to integrate with the macrofinance, which in this case could be Ministry of Finance as well as the central bank. I believe that there is a need to start bringing in the feeder industry, which is basically the fintech companies that are providing value-added services and integration, aggregation of mobile money, embracing of blockchain and crypto. I think is extremely critical, because when the whole picture starts to come together, that's when we start leveraging the advantages and adoption of the fourth industrial revolution. Now, you as a consumer, all this might sound like complete jargon. What I think consumers need to do, basically, is to also think about the efficiencies that come with mobile banking, internet banking, being able to start thinking about also their investment options and how online plays into it. At the end of the day, what really happens is that everyone is generating data or using data. And we want to encourage the growth of the digital data patterns, because we know that with our current investment, we can provide a home for the data. And then people like Experian can come in to start looking at how do we build analytics platforms that can enable enterprises to leverage and grow. So commercial banks who are looking to provide services and are struggling to figure out their customers, and Experian having the platforms to do it, both of them will not be able to achieve much if the data itself is not there. So we want to be able to provide a home for this data. But I think at the end of the day, the most important thing is to realize that we are living in the new revolution. It's driven by internet. They might call it industrial, but it's really the internet revolution. And everything is becoming internet driven, and we need to find a way of innovating within the internet space and actually making even more money than we made before in the previous revolutions. So yeah, that's really what I have to share for now. Until next time.
Thank you, James. Soren, I will call on you to respond to this, but also your parting shot and key recommendation. And this is around regulation. Should regulators be looking to regulate all data across the generation of generators of data, or should regulators be using existing structures, e.g. credit bureaus, that are already supervised to safeguard the industry data? And this is from Michael Malan. So Soren, if you can respond to that, and that will be the last question. So Akim and Paul, you'll come in with your parting shots right after Soren. Soren?
Thank you very much, and I'll try and wrap this. And the previous question about the need for human capital, and instead of a specific closing remark, maybe just concisely, the need for human capital and data analytics is strong. I think really there's no replacement for somebody that has a strong domain or sector expertise to play a role in a data analytics team. I think if we look out at solutions that are available within the industry, that there are a lot of automated artificial intelligence learning systems, again, very exciting. But the results might provide statistically valid models or things that look compelling, but something that is statistically interesting does not mean that it's good for your business, that will actually play in your markets, or that it speaks to your business model or your consumers. And we can also see some of these maybe more fancy data analytic models can be a bit of a black box and introduce biases. So the question on the need for human capital, absolutely, someone on your team should really have a strong understanding of the data that they're working with, that you're gathering, and what it means for your business and your business model, what it's good for. understand who your customers are. But that doesn't mean that you need to have a large staff of data scientists. Somebody who has a competency, even if you're very small, can help to make good advantages, even if it's saving a small amount of costs because a process has been improved. This is an advantage to you. So we can certainly look out in the industry and we can see Google, Facebook, et cetera, and feel intimidated. But let's remember that all innovators started small and that there's plenty of opportunity for innovation and from getting value from your own innovations internally. So don't feel the risk of some of these big fancy technologies and other industry players as a reason not to get started. Just kind of taking that first step actually can really yield large gains. Speaking a little bit to the question of regulators, regulators are central. I think we can all agree. And I would hope that we can also agree that all ships rise. Forget the exact analogy, but everybody is better through collaboration and communication. Clearly, there's strong data protections that need to be in place, and the regulator is central to this as well. But the extent to which we can share data in a secure way, I think, is going to provide everybody benefits. There's no model for this uniquely. And I think each country, each regulator needs to look at their own frameworks, look at their own concerns. Clearly, there's many external advisors that can provide regulatory guidance, IFC being among these organizations, among others, to give good advice on how those regulations can be structured in a way to encourage a collaborative, innovative environment, which also benefits consumers, mitigates risks, and provides financial inclusion at the end of the day. But a lot of that we do see through interoperability in one context, or different kind of players that work together in order for everyone to benefit. So I would leave that as my parting remark, just encouraging innovation internally, small, again, from your own organization, of start with a tangible problem and just make a small step, maybe a small cost savings, and get down the journey of digitization, digital transformation, but then in the macro level, promote communication, promote interoperability, and promote data collaborations in a way that everybody can benefit. Thank you.
Thank you, Soren. Paul, your parting shot and recommendation.
No, thanks once again, Michael, and everyone. Thank you very much for your attention today. I know that sometimes conferences are long, but even more so virtually. But I'm very thrilled with all these engaging questions that we've been receiving. From a conclusion perspective, first of all, thank you very much for the fellow panel members, Soren, Akeem, and James. Really enjoyed some of your insights as well. I just want to touch on what Akeem said about talking about the customer. Maybe it didn't come through quite strongly what we were talking about initially, but absolutely. Without the customer, without understanding the customer needs, we will be nowhere. And that is from a collaboration perspective, from a business perspective, and then obviously from a value towards all organizations and consumers at the same time. I think one of the most important things around this is that we live in a very exciting time. There's no doubt about it that conversation is critical. If we all work together to make sure that we can get this right, we will make it right. I know that there are some scheduled changes coming to the regulations in Uganda. I've talked about how credit bureaus at the moment can only be collecting information from financial services. I know that it was raised by one of the questions that I see in the chat. But as soon as these changes come on, the one thing that I can say is that Experian will be addressing the opportunity to collate data from multiple sources to be able to bring true value to what the specific needs are going forward. The simple reality, like I talked about at the end of the day, is that a B2B or a B2C model is something that is critically important, but it doesn't only relate to banks per se. There are supply chains that need to be protected. There's customers and suppliers that have to be looked after as well. And there's the ability from other organizations to support growth across this line at the same time. The regulations are there for a reason. And as Experian, we fundamentally agree with those. Yes, at the same time, there's also the ability to make commercial value work in a regulatory environment. But in this sort of space, in this fourth industrial revolution, what we're talking about today, in these data-driven strategies, by being able to really focus on valuable, insightful, and secure data, we know we can build value across the board for everyone on this call and everyone in the markets that we talk and operate in. And I think just finally from my side is that, reach out to us. We love experimenting. We love innovation. We love doing new things. It's a whole bunch of fun, but there's always value at the end of the day for something. And again, thank you to Michael and to the Ugandan Banking Association for the invitation to speak today. Thanks to my fellow colleagues on the call as well, helping back and forth with ourselves. And please feel free to reach out, engage. This is something that, 2 to 3 hours or 4 hours in the morning isn't enough time, because it really is exciting stuff. So looking forward to going down this road with you. Thanks very much. Thanks, Michael.
Thank you, Paul. Akim, as you bring this to a close, Akim, over to you.
Right, thank you. I think just first of all, just to say a big thank you also for having me and giving me an opportunity to share ideas here today. For me, I would like to share maybe 4 thoughts as we close. The first one really is that the 4th industrial revolution is here. And we as Africans should not be left behind again, right? We missed the first 3. I think we're still suffering from the effects of that. And I do think as the leadership of the industry, we have a responsibility to the entire continent to ensure that we're not left behind again, right? The second point really is to embrace partnerships, right? With telcos, with fintechs for innovation, with big tech. And really it's because it gives you an opportunity to better understand and serve the customers. And that really is the reason why we're doing this, right? Everyone can get a much better quality of life than they have today. The third point really is building an ecosystem, right? An ecosystem that allows people to be interdependent and rely on one another. This helps with the issues that we talked about today around developing skills and competencies. It provides opportunity to build robust structures that helps to build the trust. It helps with defining rules and regulations to set the guardrails for behaviors and practices, which also helps to build trust. And then the final point really is around leveraging on shared infrastructure, right? And this is probably one of the biggest things that the industry can do to reduce the cost to serve and deliver better value to the consumers. I know one of the questions in the chat was, I think, from a bank that describes themselves as one of the smaller banks, not having the capital infrastructure to be able to make the investments necessary to go on this journey. I think for those kind of banks or those kind of financial institutions, and indeed for everyone, the ability to leverage on shared infrastructure is a really powerful way to jump ahead and leapfrog, so to speak. And interoperability will also help to reduce costs. And I think there are quite a few initiatives already going on in the market that I think with the right support from everyone, those kind of shared infrastructure can be used to solve a lot of the challenges that will help reduce the cost to serve the customers. Thank you again, and let me hand it back to you, Michael.
Thank you very much, the panel that has given me the opportunity to moderate and share with you the insights from this very interesting session. Specifically, I'd like to thank Soren, Akim, as Paul and James. The opportunity that technology has given us to be able to have this conference, irrespective of jurisdiction, location, is just a demonstration that we are not broken. We are picking up our pieces and we are keeping running. And so to bring this to a close, without really wasting a lot of more of your time, once again, I want to apologize that we've gone over time, but these are conversations that are very critical, and I'm pretty sure we could even go on until 4 o'clock if given the opportunity. Allow me to invite Mr. Wilbrod Wall to come and give us the closing remarks as we bring this to a close. And once again, thank you, Bankers Association and the entire organizing crew of the Annual Bankers Conference. So from me to you, it's thank you to Wilbrod, and then see you all when we start again. Wilbrod.
Good afternoon. Michael, thank you very much for anchoring that second session. That had a lot of detail, and I know it was quite technical. I just want to thank all the panelists and yourselves, the moderators, for anchoring the sessions this morning, and of course our own participants, all of you online and those who were able to make it here physically. That thank you, and this was just the beginning today. There are several takeaways we talked about this morning, and I know that collaboration was spoken to very highly: shared infrastructure, digital literacy, data strategies, and most importantly, breaking boundaries. I think these were all important things that were touched on today. We still have a session tomorrow, and will be the crowning of the conference. If you just take a step back, a year, 2 years ago, who knew that COVID would disrupt the globe like this? There used to be something talked about called VUCA, all the volatility, uncertainty, complexity, and ambiguity. And they sounded like big words out there. And look what COVID has done. And it is with us. In fact, there's a conversation now going on that, and I know the chairman will speak to this tomorrow, that any business that has been able to survive in this COVID lockdown, even if you made a loss, take it as a profit. Because just surviving alone in these tough times is a bonus. And you salute yourself for that. The mental stress going on and things like that. But I think, like the theme said, don't bend but don't break. There's opportunity for us to still excel. So we are looking forward to a wonderful conference tomorrow. I would like to thank everybody today. I know it's been a bit long, but tomorrow will even be richer. We have the Governor, Central Bank of Uganda. We have the CBK, Central Bank of Kenya Governor, speaking to us. We have interesting topics in the payment space, the fraud and cybersecurity and so on. So we look forward to all of you coming again tomorrow. Once again, I would like to thank all of you, and I want to bring at this point today's session to an end. Thank you very much, team.